It is Tuesday, January 3rd here in New York City. We're getting off to a hair-raising start for 2023. Happy New Year, everyone. This is Yahoo Finance Live. I'm Julie Hyman alongside Brad Smith and Brian Sazi. And let's get right to the top three things you need to know as the clock hits 9 a.m. Futures are on the rise this morning. They have been, as we are 30 minutes away from the first trading day of the year. An upbeat forecast? No, hard to find. Wall Street expecting more pain ahead for investors. We've got the top predictions for this year coming up.
All right, big miss from Tesla. The company delivered fewer vehicles than expected to wrap up 2022. This coming off a brutal year for the stock, which saw its worst annual performance on record. We'll break it all down in just a few seconds.
And Sam Bankman-Fried is back in court. The FTX founder set to appear for his arraignment hearing today. That's at 2 p.m. We're going to discuss what could come next.
But we begin today with our top story. Tesla has reported its delivery and production numbers for the fourth quarter and full year as the EV maker saw vehicle deliveries grow 40% last year. Bottom line, this was just not up to market expectations. And we're seeing the likes of Citi, JP Morgan come out here this morning, cut their earnings estimates for this company for the fourth quarter, for 2023, and even in the case of JP Morgan 2024, this result only fueling concerns about demand for Tesla vehicles into this year.
I think it also signals just where the consumer appetite continues to be. And it is for the Model 3, the Model Y, which is really the lion's share, basically all of the production and deliveries. And it signals that you've got a consumer that is really being more cost conscious right now, too, in terms of the types of EVs that they're willing to get into, where we'll still wait for, at least in this near term, more infrastructure to come about to really support the ability to have the charging and have the vehicle range as well that many people rely on. And that would really cause even more of a wholehearted switch for many buyers out there into the EV market from the standard combustion engines as well.
Yeah, I mean, that price sensitivity is also reflected in the fact that Tesla cut prices or offered a rebate, I should say. That is how they framed it, that $7,500 rebate ahead of more government incentives kicking in. That's supposed to happen later this year, and also price cutting in China that we heard about as well for those Tesla vehicles. It wasn't just the analysts who were modeling a bigger increase. It was Tesla itself that guided to a bigger increase. Their original target was a 50% year-over-year increase in those deliveries, and they didn't quite get there. It's interesting because production outpaced deliveries, right? So, you know, we know that some of it still is that they're not selling through, perhaps.
Yeah.
It used to be that they couldn't make enough cars to meet demand. Now it seems that's not entirely the case.
And that's the biggest problem. You highlighted, Julie, the price discounts. The fact they were unable to push through enough vehicles at this lower price and come out here and blow away these estimates or even just beat them marginally, that's a huge red flag. And ultimately, I think just fuels that bear debate on Tesla's stock. We should also note, of course, Tesla is the top ticker on the Yahoo Finance platform right now. No shock, no surprise.
Well, and on the production side, to your point, Julie, they've really placed so much focus around having these production synergies. 75% of the Model Y is really just a Model 3. And so for the number of vehicles that they're being able to produce, now it just comes down on the other side, customers being willing to actually take delivery and then to continue on in the full payment of it. And I think for a lot of customers that are looking at the other options that are coming into the fray and into the market as well, they may be holding out for some of the other luxury plays that are set to come forward too, and opting not to take delivery and instead get an upgrade or just a trade-in, trade-up from their existing auto manufacturer that they may have been purchasing.
This stock is now, I'll just quickly add, this stock is now trading as an automaker gearing up for a recession. Another automaker gearing up for a recession or the impact of a recession at some point. This is not a stock trading on the future for robotaxis, not a stock trading for a potential Cybertruck market. Can care less about any of this stuff. This is a stock trading right now with concerns about demand, and I don't see that turning around anytime soon.
Well, and concerns about its CEO as well, and his double duty that he's doing over at Twitter. Just one more thing I wanted to mention on that front, on the leadership front, there's also some news that's being reported by Reuters this morning that Tom Zhu, who is chief of Tesla in China, is now getting an expanded role at the company. Now, there had been some rumors that this was going to happen or that some kind of management change was going to happen. He's been promoted. He's now taking charge of U.S. factories and sales operations in North America as well as Europe. And it sounds like, according to Reuters, he's still going to be overseeing China as well. So most of the global operations now are going to be under this guy's purview. At least, again, according to this memo that was seen by Reuters.
Yeah, a lot to continue to track with shares of Tesla. Of course, just kicking off a fresh trading year, and we'll see where shares of TSLA move as we continue to really get into the throes of 2023 and kick things off here today. Well, as the calendar has turned 2023, let's dive into what we can expect to see throughout the new year, starting with the chances of a recession or a near recession coming at some point. And I mean, this is something that we've continued to discuss with economists that we've had on our show, market strategists, portfolio strategists, in terms of what we're hearing from some of the banks right now. And one thing that really kind of stuck out to me was what Deutsche Bank is actually saying. S&P 500 rising and hitting 4,500 in the first half, and then falling in the third quarter by 25% here. It just goes to show that this could be a very volatile year that ends up either just net even or net lower at the end of the day. But it's a larger question of, could you see an actual declining year after the declining year that we saw in 2022?
Be a fun third quarter for us if that in fact happens. But on the other side of it, you have BTIG, Jonathan Krinsky. He's their technical analyst over there, highlighting the thesis. I would say that's contrarian, Brad, because the thesis is that stocks rebound in the second half of the year based on the Fed potentially pivoting on rates in the middle of this year. So the first half might be challenging. Second half might be a recovery here. Again, that's BTIG, their technical analyst weighing in.
Right, but when we talk about the expectations, right, whether it's a two-track year that's front-loaded or back-loaded, the broad expectation is that there will be some kind of anemic recovery when all is said and done on the year. And as we've talked about before, this is sort of one of the more telegraphed recessions in memory, right? That even the firms that don't expect a recession certainly expect us to sort of come up to the edge of it if we don't technically enter a recession. So those sort of consensus views are quite interesting. That fixed income view is also really interesting, right? That almost everybody we talked to has said fixed income is going to come back in 2023 after what has been a losing year for almost every asset class, but notably stocks and bonds together, which is unusual. So, there's always a little bit of a danger when something is super consensus, but it's interesting as we go into the year that we do feel that things do feel that unanimous almost.
Yeah, I'm also watching another list. I think this was from Evercore. They're babies in the bathwater stock list. Of course, that's a long-time stock market saying. Stocks, they're highlighting that were sold in December for tax loss purposes that might be bought back in the early part of this year because of the potential for strong earnings growth. Tesla is on that list, believe it or not. Not an interesting start to that thesis for Tesla today. Snowflake, another cloud play. Datadog, cloud play. And Cloudflare, another security play. So a lot of tech names that if you are trading this market, you might want to put on your watch list to see if these names that were dumped last year aggressively, if they are bought back in January.
You know, one thing that's going to be interesting to track as well is just the amount of financial fatigue, whether that be on companies' balance sheets and trying to manage through some of their own cost reductions or cost restructuring, or even at the household level. And you think about consumer sentiment, and we're probably going to get a little bit more in terms of the projections once the National Retail Federation has their conference that typically takes place in the first or second week of January. I think it's the third week this year. And so once all that starts to come out and we get this idea of where the consumer sentiment, for the amount of time we've been talking about a recession and for the holiday season that we've seen consumers have to wade through and try to manage their own finances through as well, it'll be interesting to see how much of that is continuing to go back into the economy and on corporate spending as well, because that's where we were still waiting for so much of that to come back in, even to the travel equation and leisure and hospitality that has been so battered. And so you've got it kind of on two folds, on the economic front in terms of the employment situation and where some of those dollars continue to still flow back into the economy.
Yeah, I was on recession watch for New Year's Eve. I was out. There was really nobody at the bars. What was going on? I know. I'm on Long Island. Yeah, look, I went to 4 different places. Places were not that packed. So a lot of beers in order, not a lot of expensive espresso martinis. Just a little observation by me out and about. Yeah.
Although you were out.
You were out. Was it crowded?
You got to come to Brooklyn next time.
Maybe I should, because there was missing people. There was no people.
I was at home.
You were at home.
So there were not beers being bought.
No beers. Yeah. Just Heritage cereal, right? Heritage Flakes? Heritage Flakes.
Not on New Year's, but yes, other times. All right, Sam Bankman-Fried is set to appear in a Manhattan federal court later today to face charges that include cheating investors out of billions of dollars, as well as wire fraud and conspiracy to commit money laundering. Yahoo Finance's David Hollerith has been following the story. He's with us here in the studio because he is here for this trial. So, Dave, what should we expect from the arraignment hearing is set to happen this afternoon, right?
That's right. So the initial arraignment happened within 24 hours of his extradition. And so today is the formal case where they read him his charges, and after which he will either plead guilty or not guilty. And it's very likely, based on what we've heard from his spokesperson as well as other people and other reports, is that he will likely plead not guilty at this stage. That being said, there's also going to be sort of a conference that's going to be kind of a schedules in motion, so they'll talk through But one thing I'll be looking for is body language, posture, how he's acting. And so that's probably going to give us some insight into how he's going to take the case further, what their strategy is going to be. Obviously, he's looking at 8 counts of fraud from the Justice Department. So it's a tall order, and a lot of legal sources say that really it's going to come down to how he wants to, like what he's willing to sacrifice in negotiations.
Right.
So
what is the continued tenor around the crypto sphere, if you will, as this continues to move forward and the proceedings really commence here?
Yeah, I mean, I think anybody who works in the industry, wants to push it aside as a case of fraud, obviously, fraud. But I think that in general, it doesn't affect the market as much. It's the same thing with the bankruptcy hearings in terms of actual prices, but obviously from a sentiment standpoint and how people are thinking about the asset class in general, it's not a great look.
What does this mean, how this plays out for the direction of Bitcoin? We were talking about last week, Bitcoin has really gone nowhere since the middle of June. I would imagine in large part because of this case.
Yeah, I think there's also this issue with liquidity, or not issue with liquidity. The Bitcoin and Ether are the 2 largest cryptocurrencies, so they have more liquidity. And so one thing that has been pointed out more recently is that like these smaller tokens have no liquidity, so they are a lot more volatile. And so some people are sort of arguing or proposing that Bitcoin is trading, it's fluctuating less outside of these huge sell-offs that we've seen, which are usually these companies that are in trouble because it has so much liquidity. It's typically the easiest thing to buy and sell, if that makes sense.
Is the thinking also, I'm curious here, as we head into the year, as we know that some of the prominent names in crypto were invested with Sam Bankman-Fried and therefore have lost money, have they liquidated their positions in Bitcoin and Ethereum, for example? I mean, I assume we don't know entirely, but you have to wonder if that's already happened or if that's still something that could happen at some point.
Yeah, so the events we saw over the summer were much larger selling events for the major cryptocurrencies. FTX was, you could sort of think of it as a third of that. And so a lot of people are think that potentially the SBF situation is behind us, but obviously there's this constant issue with contagion and whether or not this is affecting other companies like Genesis Lending, which is paused withdrawals, and maybe their parent group DCG. That's the big thing people are watching in terms of a major sell-off. So,
Yahoo Finance's own David Hollerith. David, we know that you're going to be tracking this federal court appearance very closely and keeping us up to date with the latest. Thanks so much, David. Appreciate it. And before we head to break, we wanted to update you on the painful event during the NFL's Monday Night Football game where Bills safety Damar Hamlin collapsed following a tackle during the first quarter against the Bengals. The Buffalo Bills say Hamlin entered cardiac arrest and had to have his heartbeat restored on the field before being transferred to the University of Cincinnati Medical Center for further testing and treatment there. According to the team, Hamlin is currently sedated and listed in critical condition. A massive outpouring of support continues around the world of sports for Hamlin as we eagerly await more updates. Hamlin is also known off the field for his charitable and community efforts, and a toy drive that he began in 2020 has seen a flood of donations on its GoFundMe page, which now has topped $3 million. We will continue to monitor any updates on Hamlin's condition and bring you the latest as more details emerge. We'll be right back. Welcome back, everyone. Keeping tabs on futures this morning. You've got some up activity here with about 14 minutes until the start of today's trading session, the first of the new year, as investors they're awaiting a busy start to 2023. More on the year ahead. TD Securities Managing Director, Global Head of Rates Strategy, Priya Misra joins us now. Happy New Year to you, first and foremost, Priya. First, as we kind of get into this new trading session of the new year, what would you be looking for in terms of just what we expect at this point in time? I mean, we've discussed at length what is going to carry over from 2022, but what is the top thing that you'd be looking out for?
Sure. Happy New Year. Thanks for having me on. I think the focus last year, I think some of that focus remains this year, which is going to be on economic data and the central bank response function. And I would say globally, but particularly for the US, we've got a lot of data over the next week. So we'll be watching particularly that payrolls report, wages. I think the key question is inflation may have peaked, but how quickly is it going to decline? Is it going to get closer to 2% by the end of this year, which will allow the Fed to start to respond to a slowing growth picture? Now, in our view, inflation is going to be sticky. Getting down from 7% to 4% might be easier, but getting from that 4 or 3 down to 2, I think is going to take a while. And so our view is that as the economy slows down, which we do expect a recession in the third quarter, that the Fed is going to struggle to respond. And I think that tension between inflation and how quickly it declines, how quickly is the unemployment rate rising, I think that's going to be with us in a market that is less liquid. And I think conviction levels are not very high. So I think we're going to see large moves. I mean, today you look at the bond market, we've had pretty big moves already, the first day of the year. So I think that just tells us there's uncertainty, there's a lot of cross currents here. And I should bring up the global issue as well. What's Japan doing with YCC? How does ECB QT take over? I think all of that we're going to be grappling with. Even though the year's turned, I think a lot of those same themes will stay with us for the rest of this year.
Yeah, a big move to start off the year indeed, and sort of a return to, I don't know, maybe what investors are looking for this year, but we'll see what ends up happening. When we talk about the Fed and how it's going to struggle to react, you're looking at a terminal rate that's higher than what the market is pricing in. Does that reflect that struggle and what the Fed has telegraphed, that is its willingness to sort of go hard against inflation, maybe at the cost of growth?
Exactly. And I should say that growth right now is strong. We just had data over the last 2 weeks that shows that the consumer is still spending, and the labor market is very tight. So the Fed really, I think, has sort of a one-way trade to continue to raise rates until they see service inflation, wages starting to come down. I think that dilemma for the Fed will actually grow in the second half, because by then the unemployment rate rises to the point where they should start to ease policy. And will inflation allow them to ease? But for now, I think they're telling us that December Fed meeting was very hawkish, and we're going to get the minutes this week, tomorrow. So we're actually waiting to see what we hear from the minutes, but the dots came in much higher than market pricing. And I think the market's calling the Fed's bluff a little bit, but they remain very focused on inflation, and they need that service inflation. I think the focus will shift from CPI and core CPI to service CPI and wages. And that, I think, is just very sticky because the labor market remains tight.
Will inflation reach a point this year that will allow the Federal Reserve to cut rates?
So I think it's both. We do think inflation comes down. We don't think it gets all the way down to a 2-handle. We've got 3.1 by the end of the year. So it's declining. It's moved a long way. But I think then we'll be looking at the labor market as well. If the unemployment rate is close to 5 in our forecast by the end of the year, and you've got inflation still above target, but we've done a lot of work, we do think the Fed starts to cut rates. So we've penciled in the first cut in December of this year. But then we have 225 basis points of cuts penciled in for next year, because by then the labor market is weak enough that the Fed may have to start to say, look, we've gone from inflation being public enemy number 1 to the labor market. And I think then they can start to respond. So I think we have to be looking at that unemployment rate as well. 3-handle or even 4.5. The Fed's own forecast has 4.7. I think it needs to be much worse than 4.7 for the Fed to start to respond by cutting rates.
If we do see the Fed start to cut rates, what indications do you believe that they will need to see in order to ensure that inflation doesn't once again try or even spark back up, even after they make that type of pivot?
Right. Yes. I think that's going to be a key thing they're going to be watching. They're really terrified. What I call the ghost of the 70s still haunts them, meaning they don't want to be early in responding to the slowdown. So I think they'll be watching inflation expectations. You know, the Michigan survey, we look at all sorts of survey measures for inflation expectations, consumer as well as market based. They'll want to see that being stable. And then I think it's going to come down to services and wages. If wages have downshifted, we're not looking at 5% wage growth, but 3.5% or even 4%. I think they can say, look, wages are starting to come off. And so some of that pressure on service inflation is declining. And we'll be also watching for consumer spending. These are all early signs. If the consumer savings buffer, accumulated savings is down, and the consumer spending starts to go down, you would think inflation follows next. So I think they're going to look at a bunch of things to make sure they are not early. I actually think the Fed was late to start to hike, and I think they're going to be late to start to cut because they are so worried that they might let inflation, might stoke inflation expectations, and then it's very hard to bring that inflation back down.
TD Securities Managing Director and Global Head of Rate Strategy, Priya Misra. Good to see you, as always. Happy New Year.
Thank you.
Coming up, Block is starting the year strong with an upgrade from Baird. We'll discuss that, plus have this year's first opening bell on Wall Street next. Welcome back. Let's dive into a few hot stocks on the move to kick off this new year. Shares of Block in focus this morning followed Baird's upgrade on the shares, boosting it from neutral to outperform with a price target set to $78. The headline here for Block, guys, Baird saying this is a comeback story. And yeah, after really a bad year, slowing growth rate over there at Block, of course, the stock was hammered. They're looking for this stock to gain ground this year.
Yeah, they also said within this that they believe Block is a premier large cap growth franchise. Both profitability and net cash benefits from macro trends, including rising rates. And then one thing to keep an eye on is, of course, the subscriber funds that they're able to take in as well. On each of those transactions, when you're either engaging with Cash App or even on the on the point of sale system that Block has for so many of those Square processors, it really does come down to how they're continuing to grow out that merchant base, and then on the Cash App side, just continuing to hold on to the amount of net users that they have. They really pride themselves on a younger demographic there, and that's where you can get into the conversation competition-wise of a PayPal versus a Block and how they're going after different businesses and then those end users for their peer-to-peer transactions platforms too.
I was just reflecting my mind on the decision to rename the company to Block from Square, which did happen last year. It happened in 2021, in late 2021 is when the decision was announced. And just like, here is a well-known consumer name, consumer and business name, right? Because a lot of small businesses use it. And that just in hindsight, I mean, even at the time, there was a lot of criticism of that decision. In hindsight, it appears to be even a worse decision. Obviously, this is a little bit this is a sidebar to this note, but just thinking about it as we get underway in 2023, just talking about what we were talking about with what happened in crypto, and you know, SBF is the symbol of that. You know,
but that's what they were trying to give a nod to, I think, with the name change, blockchain, Block,
right?
And Jack Dorsey being so vocal about what he believes the future of crypto to be and how vocal he was. A major Bitcoin, not just, I mean, we talked about Bitcoin whales and how bullish they are, but he was bullish on the underlying technology of blockchain too. And it's, I think, a question of how they're going to integrate that into their systems so that people actually realize the difference in the service when they come to use it, either on the merchant side or even on the P2P side.
Yeah, and that pre-market move we're seeing over here in Block is just, you know, I think it shows how far some of these once hot growth stocks were hammered last year, and the potential appetite to come in here and buy strong franchises like a Block / a Square if Wall Street is seeing some trough in earnings or trough in sales at some point this year.
Yeah, you see the stock was down about 61% last year. So, yeah. Brad just making a pained face at that. So it would indeed have to represent a comeback story if that was what was going to happen for the company. We also, by the way, got an upgrade for PayPal on sort of a related note this morning. This one from Truist. That's a stock getting upgraded to buy as well. And here too, there's comeback. There's the potential, according to the analyst, of M&A and buyback flexibility because they have about $6 billion in cash. So that's benefiting those shares this morning.
Also highlighting a potential, just a change in leadership, noting that Dan Schulman, of course, longtime CEO of PayPal since September 2014, turned 65 this month. Dan looks great. He's a practicer.
I was going to say, I had no idea.
He's a practicer
fantastic.
of Krav Maga. Like he's great. He's done a great job at PayPal. He's had a challenging, I would say, year and a half. But I don't see him leaving anywhere over the next 2 years. I think he's very focused on turning around this company and solidifying his legacy at PayPal.
Well, that legacy has been so baked in on some of the larger platform partners that they have as well. And when you had this company, of course, spin off from eBay and then additionally lose out on some of those larger partnerships too, the stock never fully recovered from that. And so now it's a question of where they will generate that in the future too.
Yeah, interesting stuff. All right, we got the opening bell here. First one of the year, and it looks like we're going to have a higher open. There you see representatives of the U.S. Armed Forces that are ringing the bell. They're actually doing their first ever joint enlistment ceremony among all the different branches that you see listed there at the top, which is kind of interesting that has never happened before.
It's great to see that.
Yeah, so that's who's ringing the bell this morning, as we do have indications for a higher open as we get underway. Sort of a feedback, I guess, from the end of the year, which was not very positive. We now have a little bit of a boost happening here, even though we didn't get our Santa Claus rally, right, over those final trading days this year. Although I think the Santa Claus rally typically includes the first couple of trading days of the new year as well, right?
I think it does, but you know, the whole Santa Claus rally, I would say, got overshadowed by the daily happenings in Tesla. Every day the stocks seem to go down, and that's the only thing we were talking about. And Santa, well, he took a back seat.
I guess a back seat.
Back seat.
All right, what do we got going on here this morning?
In his cherry red sleigh as well. We're taking a look at the major averages. And look at this. I mean, I'm just going to put a year-to-date chart there. Why? Because it's a clean start. It's a fresh start here that we've got for the markets here. So new year, new rejuvenation, hopefully. We'll see. Dow Jones Industrial Average opens up, though, by about 0.2%. Let me populate this chart for you just so you have a good look at what we've got coming into this. All right, so past 52 weeks, still net lower, of course. But on this fresh start, the Dow is up by about 0.2% right now. and the Nasdaq Composite. That's also seeing some gains to the tune of about 0.7%. That's frustrating to look at in that 1 year, so I'm just going to put this back on a maybe 3-day view or something like that. There we go. Green on the screen. S&P 500, you're seeing that up by about 0.3% to kick off today. And then additionally, let's take a look at some of the sector activity as we kick off this new year for the 11 S&P 500 sectors. Yeah, there we go. Perfect. We are mixed as of right now. However, you've got more advancers than laggards. We're led right now by communication services. That is up out of the gate by about 1.5%. So zoom, zoom, zoom there. And then additionally, bringing up the caboose, you've got XLE, energy. We will see what that sector holds for this year. Of course, it was the outperformer, really the only good performer over the course of last year on a sector basis, but you're seeing that open down by about 1% out of the gate, and then we'll just ride out with a look at the Nasdaq 100 and some of those tech stocks. You've got Apple starting the day down by about 0.2%. Microsoft, Google, Amazon, though, in positive territory to kick off today's trading session. Julie?
Yeah, and energy, which you mentioned, a lot of the folks we talked to are still positive on it going into 2023, which is also quite interesting, even as we see it pull back a little bit. You tend to see, like on the first trading day of the year, you see some of the worst performers from the prior year up, both on an individual and sector basis, and vice versa. So that
that's my baby in the bathwater list. Yeah, those losers in December, do they get bought back here?
Yes, they usually do on the first day, and then things move around a little bit.
I just wanted to say that. That was just
you just love talking about the
I love little
babies from the
sayings, Wall Street sayings like that.
All right, let's talk about shares of Wynn Resorts. We're watching Las Vegas Sands as well. Both of them are higher after being upgraded over at Wells Fargo. In the case of Wynn, it's being upgraded to overweight from equal weight. This coming as Macau's reopening spreads some optimism for these casino stocks. And you gotta love when we're looking at the title of this Wynn note, we need more Macau Bell, according to the analyst Daniel Pollitzer. Hats off to Daniel Pollitzer for that.
Look at that. Daniel, who's a CFA, making those jokes. Usually you don't get a lot of humor out of CFAs. No offense, of course, to our friend Sam Rowe, who has an amazing, he's a CFA and a very rich sense of humor. But this is another stock, I would say is a bull call, looking for Wynn to recover all of its adjusted operating profits this year as it had in 2019. So that is a big call, in large part hinged to the reopening of Macau, that key market for Wynn and many other casinos.
Yeah, and this, I mean, with the China travel restrictions that have really been pulled back and quite rapidly and questionably so in many of the instances, given the number of cases that are continuing to rise in the spread of COVID, it is still coming with where the reaction from other countries and the travel that goes into that region, where that is still going to hold up, and the consumer appetite for people actually traveling there too. And so that is going to be a major part that this story or even this call really hinges on, is the number of travelers that are still willing to go to those casino experiences as well. But this one potential boon on the day for at least the stock here right now.
Yeah, and the analysts also in this call on Las Vegas Sands, which they were already overweight and remaining overweight, saying we see Macau evolving as the most compelling growth story in gaming. There is some talk and chatter out this morning that perhaps the China cases are peaking or going to peak, and once they're on the downslope of that, perhaps we'll start to see a little bit of a smoothing out of what has been a very, very rocky reopening practice there. Even now, we're still seeing stories about how the crematoria in China are full. That, some of what we saw in the early days of the pandemic here in the United States is now being repeated over there, and in some cases magnified. So all of that said, the analysts here trying to look past that activity. And it's not just happening with the casinos. We're seeing China stocks that trade here in the U.S. broadly rally. Alibaba, for example, is one of the stocks that's trading higher today. And you can see the rally in other. Pinduoduo is up by 9%. JD.com up almost 6%. Alibaba up almost 6%. And so is Baidu. So this sort of broad rally in China stocks on the renewed optimism. Obviously, it's been very fits and starts, both for the actual reopening and the stock movement around the reopening.
Yeah, the Golden Dragon Index over the past 52 weeks down 20%. So it'll be interesting to watch some of those names to see if they start to chart some type of rebound as we begin 2023. We're also keeping an eye on another company that may be trying to rebound here in 2023, shares of Bed Bath & Beyond. They're actually kicking off the day higher by about 7%. The expiration date for its exchange offers for debt securities, it approaches following several extensions here. And you've been tracking this one extremely extremely closely just to see.
Yeah, it's tied to three tranches of debt, and this was there was a poor reception to this a couple weeks ago. Hence, they extended this deadline. But if Bed Bath & Beyond is unable to just do this transaction, you're really wondering how deep they can make it into this year. They need to reduce that leverage on their balance sheet to just, I would say, fund inventory at this point. And I can't help but to think back to what Anthony Chukumba, Loop Capital, told us last week. He doesn't even expect him to be around for the holiday season of 2023. And just crunching the numbers on this company's finances, it definitely makes sense to me. Ultimately, they will report earnings January 10th, and that report is expected to be very, very ugly.
You know, of all of the declines we've been talking about in various stocks, the one in Bed Bath & Beyond is especially eye-popping. The stock fell by 83% last year, and that's after an 18% decline the prior year. So this is effectively a collapse in these shares that reflects some of what you were just saying from Anthony Chukumba and obviously other investors, despite the periodic memification of the stock, which is reflected in the chart there, where you see the little spikes here and there. Eventually, reality has to, come and hit home when it comes to the shares, and that is what has happened.
Yeah, and in weakness in the home market right now, something that cyclically Bed Bath & Beyond would need to bank on, at least at this point in time, is a strong registry year. You would need to see either registries for anything from weddings and nuptials and all of the arrangements that go along with that, as well as baby registries or any type of life event. And so I think if it's a weak registry season that they see, and that traffic overflows into, say, my goodness, Restoration Hardware, or into a Williams-Sonoma.
That's where I'm going for my registry. If that day ever happened, I'm going, Bed Bath & Beyond wouldn't be around. Why do you have to go to this company?
That's the thing. Even if, and you well know there's a lot of weddings this year.
Mad weddings this year.
As we have talked about.
Mad weddings.
But the question is, you can be our anecdata as this goes on. As you go through the wedding season, I want you to report back to us. Where are people registering? I can bet you it's not going to be Bed Bath & Beyond.
Target.
No,
Target has a big registry business.
I'll take some free nuts from Target for,
Yeah, so you can keep us posted on how that goes.
I hope they register at Target, honestly. Because look, if I got to travel to the location, this is going to be unpopular for a lot of people whose weddings I'm coming to.
Register for some free food. You
My
got some
presence
curry machine.
is the gift.
Yeah.
Brad going to be sending this clip to his friends later today.
Social team. Let's get that on social. My presence is their gift.
My sister watches. She knows.
That's
fine. Love you, Laura. All right, guys, coming up, Yahoo Finance is Jared Blicker. You're going to break down the latest market action as we kick off the first trading day of 2023. Welcome back to Yahoo Finance Live, everyone. Taking a look at the major averages here in the U.S. We've kicked off the day higher across the board for the Dow, the S&P 500, and the Nasdaq leading the pack. The tech-heavy average up by about 1.3%. For more on today's tape and what's taking place early in the activity, let's get on over to Yahoo Finance's Jared Blickery at the Wi-Fi Interactive. Jared.
Yeah, it's nice to see some green to start 2023 here, but we still got to think about 2022, at least in one respect, and that is Santa Claus. Santa Claus rally still going on. You're going to hear that for one more day, and I promise I'll be quiet about it for almost short of 1 year. Here's the Dow over the last 6 trading days, extends into tomorrow, but it's already up 1%. You can see, for the most part, it's been sideways trading throughout this, 1.4% for the S&P 500, and for the Nasdaq, 1.25%. As they say, so goes January. As goes January, so goes the year, and we'll get into some stats in a minute. But I want to check out the sector action for today. As Brad went over, communication services in the lead, followed by tech, real estate, financials, all of those outperforming. And the Nasdaq, you're going to see a lot of green here. It looks nice. And we can see Amazon up 3%. Tesla, kind of the outlier here. That's down about 6-7%. But looking at some of the other major movers, Alphabet up 3%. And you got to take a look at some of these Chinese stocks because these have either been leading or lagging almost on a daily basis, kind of like the energy market. We can see Baba up 6% here, Pinduoduo up 7%, JD up 5%. And then just checking in on the EV market, we covered Tesla, but going to see NIO up about 6%. So is Li Auto, Xpeng up 8%. But of course, those are some Chinese stories there. Want to take a look at the bond market, and we are seeing a pretty big drop. Or this is the S&P 500. Let me just go quickly to the 10-year T-note yield. Pretty big drop, 14 basis points, and you can see we are back in the range from still late December right there. But we'll keep an eye on that. Anytime the bond market moves, and that's favoring growth stocks right now, we want to keep that in mind. U.S. dollar having a pretty big up candle here. Not too worried about that weighing on equity markets unless it gets above 105. We start seeing the Dixie above 105. That's going to show a declining euro. That could mean some trouble for equities. And now I just want to get into a seasonal play here. This is JP Morgan's outlook for the year. And in terms of recession risk, they're seeing 4 main scenarios. I was surprised to see, and I'm just going to summarize this, how dovish it is. They're expecting a 20% chance of a recession early in 2023 is avoided, so no recession, 20% chance, but growth risks remain, and also a 20% chance of a Goldilocks scenario where inflation falls to 2% without a recession. So I guess they're joining Goldman Sachs and thinking maybe it's not going to be that bad this year. We'll have to see what comes of it.
We wouldn't mind that. Jared Blickery, thanks so much. Appreciate it. All right, Tesla CEO Elon Musk has become the first person ever to lose $200 billion from his net worth, according to new Bloomberg data. Musk saw his fortune peak at $340 billion in November 2021. Currently stands at about $137 billion, in part because of the plunge in value in the Tesla shares he owns, which of course, those Tesla shares under a lot of pressure again in this session. Coming up, Kevin McCarthy is facing an uphill battle in his bid for House Speaker. We'll speak to BTIG's political analyst, IXIC Poltansky, on what this battle may mean for investors this year. We'll be right back.
Congressman Kevin McCarthy facing an uphill battle in his bid for House Speaker. The vote is expected this afternoon. Joining us with more on what investors should be watching this year overall, IXIC Voltansky, BTIG Director of Policy Research. Happy New Year, IXIC. It's great to see you. Maybe not such a happy beginning of the year for Kevin McCarthy, which has really been a battle for him to win this House Speaker post. How likely do you think it is that he will prevail? And why does it matter? Why is this such a closely watched race?
Look, good morning and Happy New Year right back to you. Happy to be with you. And look, I'll tell you what I told my clients so far this morning, which is this speaker's race is, I think, indicative of the way that this year is going to play out here in DC. And for me, it's basically a dumpster fire on top of a train wreck. And the reality is, that old saying that you campaign in poetry, but you govern in prose is a real one. And it's easy to organize a political party around certain ideals, but governing is tough. And I think what we're going to see today is Kevin McCarthy struggle to get the speakership. He will not get it on the first ballot, which, by the way, Julie, is the first time that's happened in a century, where a speaker didn't get it on the first ballot. And I don't know how it's going to end. There is a very good chance that we go into the wee hours of the morning. But for investors, I think the takeaway here is governing is going to be tough for the next year or so. And if we can't have one of the major political parties agree to who their leader is, how are we going to have agreement over things like the debt ceiling, like the federal funding deadline in September? And that's what I think is the real takeaway for investors.
IXIC, that said, and with the changes that we're going to be watching for in Congress as well, what is the biggest shift in public policy that investors should be preparing their portfolio for this year?
Sure. I think there are two. Number one is the fiscal put is gone. And that's something that over the past few years with COVID, we've seen extraordinary, historic levels of spending. That's over. And so if we do have a downturn this year, we should not expect federal spending to come and save the day. We're going to have a Congress with many of its constituents and many of its leaders getting in there because of the inflation reality. So they will be very, very opposed to any spending increases. So that's the number one policy takeaway. Number two is when Congress becomes less active, we should expect the alphabet soup here in DC, everything from the EPA to the CFPB to become more active. And that administrative state will get going here in the next few weeks.
IXIC, it doesn't sound like a backdrop that is just ready to embrace any form of new crypto regulation, which, of course, many would argue in the wake of FTX is badly needed.
Yeah, look, I think that we are going to have some serious and some substantive discussions about crypto regulation. And I do believe that we're going to have stable coin legislation this year. And that, Brian, is because lawmakers kind of understand what stable coins are. They're kind of like a money market account. They're kind of like a deposit account. They can wrap their arms around that. But anything more sweeping, anything more comprehensive, I think is going to face the same headwinds we've seen over the past year, which is you have jurisdictional fights, you have too many cooks in the kitchen from both an agency perspective and a lawmaker's perspective. And those cooks still haven't really agreed on what they want to cook, because some of them want to ban crypto altogether, while some want to have a more constructive regulatory regime that allows for growth and innovation.
There seems to be more agreement, perhaps, on the cooking of TikTok, so to speak, if we're drawing an analogy here, IXIC. We recently had the ban on federal employees having TikTok on their phones. Where do you think we go with that in 2023 if Congress is going to be looking at broader regulation?
Some estimates suggest that TikTok's ad revenues last year were around $6 billion. And that is incredibly meaningful, especially when we start talking about the potential to ban TikTok domestically, because those ad revenues would obviously go elsewhere in the online advertising ecosystem. So this is something that our clients care deeply about, and we try to follow closely accordingly. Personally, Joy, I'm bearish on TikTok getting banned. We're going to have a constant barrage of headlines. In fact, the new chair of the House China Committee called TikTok digital fentanyl, which I think is a noteworthy framing for TikTok more broadly. But DC is about people and process. Julie. And when I look at the process, you still don't have enough support for the legislation on Capitol Hill. There's only one Democratic co-sponsor for a bill that would ban TikTok. And we look at the people, it's been noteworthy to me that some of the top Democrats, including Mark Warner from Virginia and Angus King, two Democrats who are on the Senate Intelligence Committee, are still very concerned about banning TikTok because of some of the censorship dynamics. And so, look, ultimately, I think that you're going to have a lot of hand-wringing, a lot of finger-pointing, but my bet is that TikTok gets a deal with CFIUS, the multi-agency regulator, later this year, and that they're still operating a year from now.
All right. Well, we'll take that to the bank, IXIC, and we'll check back in with you, of course, periodically to see how things are going down there in D.C. Thanks so much for being here. IXIC Beltansky, BTIG Director of Policy Research. Appreciate it. Coming up, AMC CEO Adam Aron is fighting back against critics on Twitter following his salary comments. Saz has got to take, of course, next. It was a rough year for AMC shares. They were down 85% to wrap up 2022. CEO Adam Aron is wasting no time fighting back against critics. Well, he always kind of does. He's coming out swinging on Twitter over the weekend. The Twitter storm caught the attention of our Brian Sazi, and that's where we find his take today. Last week, of course, he said he was not going to take a cash salary, right, this year.
I love this stuff. And this tweet, look, Adam's catching a lot of heat. AMC shares have been under pressure, but I just giggled at this one. See,
I love that you're on a first name basis with him. You always refer to him as Adam.
Actually, it's AA. It's just, it is
Double A.
It is what it is, yeah. But anyway, let me just read this tweet, okay? I don't want to give you too much insight into what I, may or may not be texting. So Adam Aron, or AA in this case, so much garbage info spreading about AMC by twisted conspiracy theorists. This is a very aggressive tweet by Adam Aron, not something I've normally seen by him. He's always an aggressive tweeter, but this, I think, ratchets up the pressure on whoever he thinks is attacking AMC shares. Unclear. I think he might be referencing people on social media and Reddit, but to me, unclear. I can't imagine institutional investors who's referring to them as conspiracy theorists. But nonetheless, let me walk through the rest of this and why you've seen AMC shares.
Are there institutional investors in AMC shares?
Yes, there's oh yes,
I
yes,
know, I'm
yes.
just
This
teasing.
is just
I'm just
entirely
teasing.
owned by retail, Julie. All right, so let me go run through this here. You've seen AMC shares down 85% last year. The box office was, of course, weak. Cineworld bankruptcy, that hurt investor sentiment. And to that point, also got a report this morning that Cineworld is not in talks with AMC for AMC to buy some of its assets. Of course, Cineworld, again, going bankrupt in September of last year. And of course, concerns on AMC diluting existing shareholders with new transactions has taken a lot of different, made a lot of different moves to raise cash, reduce leverage on its balance sheet. But this year, there is hope or projections that maybe the box office gets a little bit better with some key movies coming out. Last year, Comscore projects that the U.S. box office hauled in $7.2 billion. That's down from $11 billion, and Adam mentioned in his tweet from 2019, that's of course pre-pandemic. But this year, you have the folks at Comscore telling Yahoo Finance last week, this year will be having more movies in terms of quantity year over year. That should be good for movie theaters. And this year we'll have more potential blockbusters on the docket, Creed 3 and Indiana Jones 297. And then also 2023 likely be better just optically versus last year. Now, given all of this, you have to think this year is marginally better at the bare minimum for an AMC, just given how weak things were last year. But I do expect more financing transactions from this company. They have to have a lot of leverage on that balance sheet. They have to free up that so they can ultimately show some better profits, better cash flow as the theater comes back.
I don't know. They were trying to throw some haymakers this year in terms of the box office and the movie industry. You had everything from Marvel to, of course, you had DC Comics with Batman out early on in the year, and then earlier in the year, Top Gun as well. And then, of course, Avatar entered the equation, which was lackluster at the blockbuster kind of events that they were hoping for. So it is a large question of what titles will be the ones to actually get people back in the theater experience, especially if they're crunching some of their own numbers and their own spending on that.
And too, you talked about it a lot, Brad. It is expensive going to the movies. And Julia, you're trying to go bowling over the holidays.
Also expensive.
$300 trip. It's trip to go out. It is expensive to go out and get some of these experiences that have always been somewhat kind of affordable. Now they're just unattainable for many families.
By the way, that rally didn't last long. Stocks are all down now.
My gosh. All right. My fault, guys. Taking a look at the major averages. Yeah, we have flipped into negative territory. We're down by about 0.3%, 0.4% here on the Dow. The S&P 500 down 0.2. Nasdaq down by about 0.2 as well. Coming up, everyone, on the start of the next hour, our next guest is anticipating a more challenging macroeconomic environment in 2023. We're going to discuss that on the other side.
Hey, Happy New Year. Welcome back to Yahoo Finance Live. I'm Brian Sazi alongside Julie Hyman and Brad Smith. Some red on the screen kick off the new year. Really, we saw a reversal around about 9:58 a.m., I would say. Right now, we're seeing all three major indexes in the red at this moment. Now, here's what's on tap this hour. We'll dive into the outlook for cannabis stocks with industry expert Vivian Azer from Cowen. And weak stock markets haven't prevented a big capital raise for Elon Musk's SpaceX. We have the numbers. And big tech may have a corporate governance problem, reports Yahoo Finance's Ali Garfinkel. Ali will join us with her reporting. Brad, over to you on this reversal that we've seen in the markets really just in the past 10 minutes.
Yeah, I pulled up a chart of the Dow Jones Industrial Average here on our Wi-Fi Interactive. Right now, we're down by about 0.1%. You can see where we started off the trading session. We were higher, of course, fractionally on a percentage basis there. But then the Dow did start to reverse course here, give back some of those gains, and even move into negative territory just before the 10 a.m. hour. We'll continue to track some of that tick by tick. The Nasdaq Composite, as of right now, you're seeing that down by about 0.1% as well. And then the S&P 500 flat just barely to the downside. Let's take a look at some of the sector activity. Early in the trading session, we did have communication services really in the lead here. It's still holding on to those gains, and it is the outperformer for the major sectors. The 11 S&P 500 sectors are relatively split right now. I'll just kind of populate this chart for us for communication services. Past 3 days up by about 3.4, 3.5, 3.6% actually there a moment ago. But also bringing up the caboose here, you've got consumer discretionary. So a little bit of weakness there out of the gate to start off 2023. Let's also take a look as we are kind of in the Boris season, if you will. Buy online, return in store. That's taken place around a lot of the shopping and retail industry, if you will. So taking a look at some of those major retailers, Walmart actually up here on the day by about 0.8%. Target, whatever you're calling them at home, call them in the green by about 0.9%. And then you've got a host of other retailers. Ross Stores is actually lower by about 0.6%, and TJ Maxx, you're seeing that for the Maxinistas out there, down by about 0.8%.
Boris season. You just made that up right now. That's real time. That Boris season.
Boris season.
Saz wrote that down. That's how good that was.
That was
Buy
really good.
online, return in store.
That's great. That's awesome. That's creativity. That's what we do here at Yahoo Finance. All right, let's say on all things creativity and markets. 2022 was a rough year for stocks, to say the very least, with inflation and recession still on investors' minds. As we begin the first trading week of the new year, several 2022 headwinds to be pulled back into focus in 2023 as economic data picks up in this holiday shortened trading session. Let's bring in our very own markets reporter, Alexandra Semenova, with the look ahead. And it is going to be a busy week, shortened trading week, but lots going on.
It is, guys. Well, first of all, Happy New Year. Investors are getting a clean slate, but not necessarily a fresh start for the new year. Many of last year's troubles are likely to persist into 2023. Still high inflation, persistently higher interest rates, and of course, the resulting possibility of a recession. We see those pressures again with stocks this morning, and traders will be further reminded of them once economic data picks back up this week. The two headline events of the week are the release of the Fed minutes tomorrow afternoon and, of course, the all-important December jobs report Friday morning. Investors will pore over the Fed minutes tomorrow for clues on what the central bank will do when it meets again at the end of the month and is expected to deliver another rate hike February 1st at the conclusion of its discussions. And those minutes will also offer some insight into the Fed's slower but higher thinking. As we saw last month, officials are now talking about downshifting rate hikes. We're still expected to get at least another 75 basis points worth of hikes. They're just going to come in smaller increments. And then the jobs report will be really important on Friday. The labor market has so far pretty much breezed through monetary tightening last year. We've been getting continuously high readings. We could get another high reading on Friday, with economists expecting a reading of 200,000 jobs for December. And this could be an area of concern for investors because the labor market's tightness has kept inflation quite sticky. We've also got more labor market data from the job openings and labor turnover survey. We'll get ADP's private payrolls reports, weekly initial jobless claims, and the Challenger job cuts report also due out. Earnings season is in a quiet period, but we could start getting some warnings from companies on what they're expecting. Analysts have warned that we could start getting, some bad news trickle in.
Fun stuff. I'm curious for a vibe check also. Like, you read a lot of notes, you talk to a lot of people, we talk to a lot of people. It definitely seems like there is a very cautious sort of downbeat vibe going into this year. Is that your impression from what you're seeing and hearing?
Exactly, Julie. Many are saying that 2023 will unfortunately be just a repeat of 2022. Again, we might get some improvements in individual readings like CPI and the jobs report. However, until we get indication from the Fed that they're ready to pause rate hikes, to stop hiking, to even cut rates, we won't get any meaningful change in sentiment around stocks. The outlook is pretty negative for the most part. People see stocks going nowhere this year, or at least, just a little bit higher. But it's not looking much better for 2023.
Dan Loeb tweeting LFG, right, over the weekend?
Yeah.
He's fired up. He's ready to rock and roll.
Are you serious?
Yeah. All right, ready to rock and roll.
Okay. All right. Thanks, Alex. Appreciate it. And yeah, I missed that tweet. And here to discuss market expectations further and economic expectations is Andrew Patterson, Vanguard senior economist. Andrew, thanks for being here. Happy New Year to you. As we've been talking about, there really does seem to be a big consensus that there will be a recession this year, or we will be very close to recession. I believe you guys are in the actual recession camp. When this is such a consensus view, is there a danger that we're actually talking ourselves into a recession, or how are you thinking about the perception of the recession as you forecast the recession?
Sure. Happy New Year to you, and thanks for having me. As you mentioned before, talking yourself into a recession, sentiment plays a big role in all of this, right? And the Fed is keenly aware of that. Whether you're talking about GDP growth, labor market decisions to hire and fire employees, whether you're talking about inflation, right? The Fed has been fighting that expectations battle all along. So they actually do want to see a degree of pessimism within financial markets and try to keep a lid on inflation expectations. Because if those were to become unanchored, that's what they're really trying to push back against, because that's when you start getting those wage price spirals that are akin to what we went through back in the 1970s and 1980s.
And so, Andrew, what I've continued to try and get a grasp on if one reading, of course, does not make a trend, then how many readings does make a trend in terms of the economic data that the Fed is going to be looking into?
Sure. So far, we've gotten two positive, I guess, if you're hoping for downward pressure on inflation, two positive inflation reports, which, again, as you mentioned before, is not a trend in and of itself. But if they continue to see that progress over time, there's likely to be bumps along the way. But if they continue to make progress towards their 2% goal, right, there was a lot of I don't want to say jubilation, but excitement around those inflation reports. But 6% inflation is better than 9% inflation, but it's still a long way away from 2% inflation. We think towards the end of the year, they're probably going to end up somewhere around 3%. So still with a little bit of wood to chop in 2024, but hopefully continued signs of progress going forward.
Lots of mixed economic signals coming out of the gate here, Andrew. What's keeping you up at night?
I would say it's that wage price spiral I mentioned before. So wages still remain high. We'll get a little bit more information on that on Friday with the jobs report. You mentioned JOLTS coming out as well. So we'll get to see the job openings per unemployed. We'd like to see that number come down a bit. If wage growth were to remain persistently high, especially if that's combined with an unanchoring of inflation expectations, which is a big worry of the Fed, again, that's when you get into that wage price spiral, which the Fed is trying to avoid.
Do you expect some of the either hiring freezes or even layoffs that have already ensued, especially across the professional business services and in some other sectors as well, to have kind of a permeation across the wage growth side too, and have maybe not intended impact, but it is going to have some type of effect on wage growth?
So it actually is intended. Again, it's painful, right? Nobody wants to see job cuts. Nobody wants to see the unemployment rate increase. But higher unemployment rate, our call is for it to rise to maybe call it around 5%, which is not necessarily what people associate with recession type levels. But you're still talking about an additional 1.5 to 2 million people out of work. Very, very painful with them. But unfortunately, that's the type of conditions we're likely going to have to see to really start putting downward pressure on wage growth. And the Fed's been very transparent about this.
The Fed has been very transparent, including that the dot plot indicates the terminal rate's going to be, 5.25% or so. Where are you at in terms of the terminal rate and how it feeds into everything else you've been talking about?
Sure. We're right in that neighborhood, around 5.25%. We think even as important, if not more important than the terminal rate itself, is just how long they stay there. And we believe the Fed has done a reasonably good job of trying to communicate to the market just how long they intend to stay at that terminal rate, right? Because terminal doesn't mean cuts are around the corner. It just means they're done hiking. They do want to maintain that pressure on the economy. They do want to see, again, downward pressure on wages, an anchoring of inflation expectations, and inflation itself starting to come down. They do know that once they get to that terminal rate, they're likely to have to stay there for some time, and the market is starting to finally come around to that idea.
Andrew Patterson, Vanguard senior economist. Good to see you. Happy New Year.
Happy New Year.
All right, the market is awaiting some important holiday sales data from Costco on January 5th. Sentiment is negative ahead of the report after a weak sales reading for Costco for November. Writes Guggenheim's John Heinbockel, the rare negative sentiment that began with November's sales shortfall and that has driven the shares 9.4% lower the past month persists ahead of the December sales print on January 5th. Based on our conversations with investors, this incorporates another below trendline sales result as well as below consensus second quarter earnings in early March. Coming up, the valuation for SpaceX is taking off. Julie's back with that, plus more top headlines you need to know next.
Let's get down to business with some other headlines that we are following this morning, starting with SpaceX, whose new funding round values the company at $137 billion. That's according to reporting from CNBC, which cites company correspondents. Elon Musk's reusable rocket and internet satellite company is raising $750 million in this round. It's set to be led by Andreessen Horowitz. Bloomberg recently reported that SpaceX would allow insiders to sell shares for $77 a piece. That would have valued the firm at almost $140 billion. And back in May, it was valued at $127 billion following a funding round at that point. And new year, new General Electric, its healthcare unit now, is separate from the main conglomerate, and it begins trading as its own company tomorrow under the ticker symbol GEHC. GE Healthcare will be a part of the S&P 500, also replacing real estate firm Vornado. This separation is part of years of restructuring that now sets up the final spinoff. The natural gas-powered turbine and wind turbine business will be combined with other GE energy businesses. The new entity, GE Vernova, is expected to split off in early 2024. The remaining GE will contain the jet engine business. And South Korea regulators are fining Tesla $2.8 billion won, or roughly $2.2 million US dollars, for alleged violation of advertising law. Its antitrust watchdog, the Korea Fair Trade Commission, says Tesla exaggerated, quote, driving ranges of its cars on a single charge, their fuel cost effectiveness compared to gasoline vehicles, as well as the performance of its superchargers. That's saying it on its official website. Since 2019 is how long it's been allegedly going on. A South Korean consumer group also found the driving range of most EVs drops by up to 40% in cold temperatures when batteries need to be heated, with Tesla suffering the most. Sas?
Kevin McCarthy finds himself in a down-to-the-wire battle for House Speaker. Yahoo Finance contributor Kevin Cirilli has been tracking this one for us. Kevin.
It's a battle down to the wire. Later this afternoon, when the 222nd Congress convenes, their first order of business will be for the Republicans to look into to try to elect a speaker. And I want to correct myself, the 118th Congress, 222 is the number of House Republicans who have been elected to this new Congress, and 218 is the number of votes that Kevin McCarthy needs in order to secure becoming speaker. The drama that could unfold on the House floor later today, it could be something that we haven't seen in quite some time. They're going to continue to take roll call after roll call vote. And these 5 hardline Republicans who have opposed Kevin McCarthy at all costs, they really could be the reason that another leader gets elected to the speakership. But Kevin McCarthy is operating as if he's already got this short up. And it has Washington buzzing about, if not Kevin McCarthy, who. We've heard some other names thrown around, including Steve Scalise. But this could really pose a wide variety of potential options on the House floor and a lot of different drama. The Democrats have said they're not going to do Kevin McCarthy any favors. If any of them leave the floor, the margin of victory that Kevin McCarthy needs to become speaker shrinks. So any Democrats who leave the roll call votes later this afternoon, that would actually help McCarthy. And that would only embolden the hardliners as saying that McCarthy ascended to power with the help of Democrats. So it's some fascinating dynamics that are going on. And truthfully, it's the biggest unknown here in Washington. And it's a toss-up, to be blunt.
Well, staying on the topic of Congress, what does a divided Congress mean for the debt ceiling this year?
Well, I think that this is the biggest underreported story that we have seen coming out of Washington. And quite honestly, it could wreak havoc on markets in the next 4 to 6 months. Congress is going to have to pass some type of debt ceiling to raise the debt ceiling, likely at the end of this quarter or early summer. Now, they could pass a short-term extension, and that would punt it into the fall. But either way, the drama that we're seeing unfold with Republicans in the House of Representatives, led, of course, by the Freedom Caucus, the ultra-conservative wing, could really be a foreshadowing of the potential drama and the economic fallout that could be happening in the next couple of months. I do want to note that when you talk about the debt ceiling, you now have some Democrats who are saying to get rid of it altogether. That's a non-starter with even moderate Republicans. And you also have some unknown variables happening geopolitically with China as well as with Europe. So the global economic outlook, especially when we talk about a recession in the United States, this debt ceiling is perhaps the biggest, again, unknown variable, and the timing of it. And historically, it has really caused a lot of havoc in the markets. And so, again, I just want to keep reiterating, in the next couple of months, watch the debt ceiling, watch the fights coming out of Congress. And what's happening today is a preview of that fight.
You mentioned China also, Kev. So let's talk about China's foreign minister, who said he is deeply impressed with Americans, which is really interesting there. What can we read into that commentary?
It's very interesting. So here you have the former ambassador to the United States for China getting a promotion of sorts to becoming now the foreign minister. And he issued several tweets in the last couple of days in which he says, quote, "Everything in the past is a prologue. I will, as always, care about and support the development of U.S.-China relations, promote U.S.-China dialogue and exchanges and mutual understanding between the two peoples, promote mutual respect, peaceful coexistence, and a win-win cooperation between the two countries, and contribute to the well-being of the two peoples and world peace, stability, and development. I mean, this was, as we start the new year, perhaps a further continuation of some warming of the tensions between the U.S. and China, especially given what's gone on in the last couple of months as it relates to some top officials visiting Taiwan. But clearly a sign of a fresh start, dare I say. Maybe I wouldn't go that far, but some warming of rhetoric versus what we've seen in the last 2 years coming from that same office, most notably with his predecessor meeting with Secretary of State Tony Blinken. So a different tone coming from Beijing.
All right, it's going to make for an interesting year of the rabbit. Yahoo Finance contributor Kevin Cirilli. Thanks so much, Kevin. Appreciate it.
Thank you.
Coming up, everyone, blazing into 2023, what to expect from cannabis companies after the latest legal setback. That's next. Cannabis stocks kicking off the year with no sign of legal reform in sight after the Safe Banking Act failed to make its way into Congress's year-end spending package. That would have given the industry access to normal banking services. So to discuss what's next for the space as industry debt continues to rise, we've got Cowen Managing Director and Senior Research Analyst Vivian Azer. Vivian, great to have you here with us this morning. So what next in terms of any types of legal reform or actually just any type of legislation that can move forward from here, or at least give the cannabis industry some hope for that regulation to come forward to be able to operate more safely, if you will?
Well, unfortunately, given the lack of progress that we saw out of the last Congress and SAFE not being added to the omnibus bill, we're really in a status quo situation. So we haven't changed any of our estimates in terms of industry growth because the industry will continue to rely on state level legalizations. We've got New Jersey is a new state that came online last year, New York this year, and a couple others in the Northeast. But our outlook is not at all constructive on regulatory reform in the 118th Congress.
And Vivian, it's Julie here. The backdrop otherwise for cannabis isn't fantastic either in terms of the debt that a lot of these firms have taken on in a rising interest rate environment. Is 2023 a year in which we're going to see some of these guys go out of business?
I think the reality is yes. We did try to flag that in our follow-up note after the disappointment around the omnibus bill, that this would, we think, lead to a shakeout. The cost of capital remains incredibly high in the cannabis industry. And the unfortunate reality is, given the state-by-state nature of the industry, there is a lot of capacity that's come online. And so price deflation has been a headwind that the industry has been contending with for the better part of 12 months now.
Vivian, which cannabis player is best positioned this year and why?
We continue to like Green Thumb Industries as our top idea. They have a nicely diversified geographic footprint in close to over a dozen states. They have one of the highest adjusted EBITDA margins in the space, and they're operating cash flow positive.
And so do you expect that we'll see some type of M&A environment now continue to kind of move forward within the industry for more of that vertical integration in the absence of some of the legislation that was supposed to come forward?
I mean, I think asset prices are going to come down. You've certainly seen it in the public equity markets, but given the amount of price deflation that you're seeing, you are going to find that there are going to be certain operators that are really challenged to finance that debt, to your point. And so you could see further consolidation in the industry, to be sure.
When can we expect, if ever, federal legalization at this point, Vivian?
We're not counting on it in the next 10 years. It's not factored into our model, fortunately.
Wow, 10 years. I mean, this is something people in the industry have been talking about for a long time, and there seemed to be a decent amount of optimism as recently as this past year.
We've never factored in federal legalization into our modeling work. That just seemed really optimistic. I'm really grateful to have Washington policy partners at Cowen as part of the Washington Research Group that have really helped inform the way that we think about legislative change. And we've consistently tried to be on the conservative side there since we continue to get disappointed by Congress.
And so if you have to take the U.S. out of and the market here in the U.S. out of some of the valuations then for these companies, where are the growth prospects elsewhere in the world? And is there legislation moving forward there?
Well, I should just reiterate that the underlying growth for the U.S. cannabis industry continues to look very, very good. We are modeling for a double-digit compound top-line growth, just with incremental states coming online, like New York, which is going to be a big one, as I noted. But Germany does seem to be moving forward with their own adult use legalization. There are certainly other EU member states that are watching that very closely.
Vivian, have we arrived at that point where cannabis is finally being viewed by consumers as a true replacement to alcohol? I know we've talked about it for a few years, but we're seeing a lot of new formulations out there, notably in the gummy space.
We think so. So we did a deep dive on that, revisiting some analysis that we had started doing, over the last 6 years. We've been covering the cannabis industry. And what we were able to do was to look at Nielsen data for alcohol sales, beer, wine, and spirits by state. We were also able to look at BEA data by state. And what we've been able to show is that over the last couple of years, you finally are starting to see a divergence in alcohol purchase behavior, whereby consumers that live in states where they have access to legal cannabis, either adult use or medical use, aren't buying nearly as much alcohol. There's about a 1% difference in alcohol growth rates when cannabis is available.
Vivian, I'm going to take a little bit of a left turn and ask you about psychedelics also. And I don't know if this is in your coverage universe at all, but considering you were on the cutting edge of marijuana research when the industry was really just starting, now we're seeing a similar effect in psilocybin, for example, which just became legal in Oregon for therapeutic use. We're seeing definitely more interest in that area. Do you think we'll see a similar arc that we have for cannabis, or do you think that's a really different story?
Yeah, I don't cover that subcategory for us. We actually cover that out of our biotech team.
Gotcha. Okay, fair enough.
All right, we'll leave it there. Cowen Managing Director and Senior Research Analyst Vivian Azer. Good to see you as always. Happy New Year.
Happy New Year.
Coming up, taking off into the new year, we'll speak with the Points Guy's Clint Henderson on the state of travel. That's next. The holiday season has come and gone. We're now left in the aftermath of one of the worst travel weeks ever. Thousands of flights delayed or canceled. Customers are still in search of answers and some compensation. For more on travel, we welcome in the managing editor of news at the Points Guy, Clint Henderson. Clint, good to see you. Good to see you on the ground, not in the airport, given all the craziness that has been going on. Let's start with Southwest, because they are the causer of some of this latest craziness. Do you see them being forced to now offer aggressive discounts this month or this quarter just because of what happened during the holiday season to them?
You know, it's a really interesting question. They're in reputation rebuilding mode right now. So far, I haven't seen a lot of deal alerts from them, but I expect that will ramp up as we get into the new year, just because they've got a lot of reputational aura to restore. And I think one of the ways they're going to lure passengers back is with cheap flights. So that will be really interesting to see. The more important thing, I think, for Southwest right now is to really make sure they're compensating passengers whose travel was interrupted, who, you know, got Christmas ruined in some cases. So Southwest is really going to be trying to prove itself again. Already, we are seeing some anecdotal evidence that Southwest has been issuing refunds, that they have been processing some people's claims. So we'll have to hold them to account over the coming weeks and months to make sure that they do right by their passengers.
After an event like this, what type of hit do Net Promoter Score or even just the overall customer sentiment do we typically see on any travel operator as Southwest is going to have to navigate through?
You know, American consumers have very short memories, especially when it comes to airlines for some reason. So they want the cheapest ticket possible. And so I don't expect this to have huge long-term ramifications for Southwest. You know, we saw meltdowns from airlines like Delta and American Airlines over last Christmas. and they didn't really take a hit. You do hear some consumers say, I'm never going to fly Delta again, or whoever, but they tend to forget that when they're pricing tickets the next time. So that remains to be seen. I think Southwest's meltdown was pretty spectacular. So they did do some damage to the brand, but I think they'll be able to turn things around really quickly. And that's another reason I think you might start to see some discounts for them to try to get consumers back.
Well, what are we seeing sort of industry-wide in terms of discounts or in terms of pricing? It seems like pricing is kind of holding up here, but are we seeing any kind of pushback or changes in decision-making from consumers?
So it's really interesting. There's a couple things going on. First of all, I would say 2022 was the year of revenge travel for domestic travelers. So U.S. destinations like Hawaii, Alaska, national park destinations in places like Bozeman. I think 2023 will be all about international travel. So revenge travel to more wider, more exotic locations. And I think you're going to start to see some prices go up in 2023 for international destinations. I'm starting to see some anecdotal evidence that prices have dropped substantially for domestic destinations. So we're seeing deal alerts to places like Wyoming, Alaska, Hawaii, places that were not on sale in 2022. So that's going to be an interesting trend to see what happens there. I think, domestic travel fully recovered. We're back to, and then some 2019 levels in many cases. I think business travel has not fully recovered. We may be at a new normal of lower business travel, and international travel still has not recovered. So we have seen extraordinary deals when it comes to international travel. Those deals may become fewer and farther between as more and more people want to travel internationally.
Yeah, we've continued to monitor where the return of corporate travel in comparison to a lot of the leisure and revenge travel has been, and how much historically that has mattered for the bottom line, for the profit margins for a lot of these businesses too. But then even if you go into the car rental side of the equation here too, it really does come back to where the car rental businesses will also see some type of resurgence, along with the broader trend of people going back into travel in this golden age of travel that some executives who we've interviewed have talked about.
Yeah, for a couple of years, basically, we have at the Points Guy have been reporting on the car rental apocalypse. You couldn't get a rental car. If you could, you were paying through the nose for those rental cars. That has stabilized. So the fleets, for the most part, have been rebuilt. Remember, during the pandemic, a lot of the car rental companies sold off their fleets for cash, and they've since rebuilt those fleets. So prices have stabilized and have come down. Even in places like Maui that were almost impossible to get a rental car, you can now get a rental car at prices that are approaching 2019 levels. So definitely some stabilization in the rental car market. We tell people at the Points Guy, get one of those premium credit cards. It will get you automatic status in some of these rental car programs and can help ease the pain, because we're still seeing long lines and short staffing, et cetera, at car rental companies too.
And Clint, on the topic of prices, a lot of recession fears floating around the economy to kick off this year. Is that impacting, and we just mentioned Southwest prices, but is that starting to cause price cuts or declines at other airlines?
So it's interesting. We have not seen a lot of dramatic price cutting. Remember that January, February, March is traditionally one of the slowest periods in the airline industry. Business travelers are not really traveling as much. Leisure traveler has dropped off because it's wintertime. So prices are down substantially in January, February, March. But right now, prices for spring break, summertime travel are inching up again. So you might want to think about booking those trips now. And if you're a deal hunter, now is a great time to travel. Remember, the crowds are not there. If you want to go to a place like Europe, you can find really good deals, places like Portugal, and even places that used to be really expensive like Oslo. So there's a lot of discount carriers going into the market.
I gotta say, I don't know when you're looking or what you're looking for. I'm looking to go away. Maybe it's because of when I'm looking. I'm looking to go away for spring break, and I'm not finding any bargains anywhere.
That's what I'm saying. I'm saying your bargains are going to be January, February, March. Once we start getting into spring break and summer travel, that's when things get a little trickier and a lot more expensive. In fact, prices are higher than they were in 2019. Pre-pandemic.
And
so
those Miami beaches,
especially domestic.
Miami beaches.
No, but like I'm subject to the tyranny of the school system, right? I'm not going to pull my kids out of school for a random week in February.
That's the beauty of points and miles. So now is when you need to build up your points and miles so you can use those when cash prices are really high. That's what we preach at the Points Guy. Earn those points and burn them when prices are high, like holiday travel. Open a couple credit cards now, and then you can book your holiday travel on points when cash prices are obscene.
Okay, all right. I'm getting the preaching a little bit. Thanks so much, Clint. I appreciate it. Point Sky Managing Editor of News, Clint Henderson. Appreciate it.
Good to see you. Happy New Year.
You too. Coming up, Bob Iger is back at the helm of Disney, of course, but what are his top priorities for this year? Whew, he's got a lot to deal with. We'll talk about it next. Disney was down over 40% in 2022. That was its worst year since 1974 as the media giant grappled with changing leadership and higher streaming costs. But as Bob Iger retakes the helm, what should investors expect in 2023? Yahoo Finance's Alexander Canal has the details.
That's right. Bob Iger returning as CEO of Disney was quite the shock for investors. But as he settles in once again to this role, there are several key questions he'll have to address in the new year. Number one, streaming profitability. How do you make money on a business that's burning through cash? Losses for Disney's direct-to-consumer division, which include Disney Plus, Hulu, and ESPN Plus, totaled $4 billion for the year as the company spent big on new content. As a result, Disney established a cost structure task force and warned of hiring freezes and layoffs in order to rein in spending. Management said it expects streaming losses to shrink by about $200 million in the first fiscal quarter of 2023 before reaching profitability in fiscal 2024. How Iger plans to get there is a key question that many analysts will be hyper-focused on in the new year. Number two, the future of Hulu. Will Disney finally commit to buying out Comcast's 30% stake in the streaming giant? To catch you up to speed here, Disney owns 2/3 of Hulu, with Comcast controlling the rest. Under the terms of the agreement, Comcast could require Disney to buy out its stake as early as 2024. Iger needs to decide the true monetary value of Hulu to the company's overall streaming strategy. Does Disney want to continue to run multiple streaming services, narrow in on Disney Plus, or have one platform that hosts everything? Which brings me to question number three, sports behemoth ESPN. Keep it or spin it off. Analysts seem pretty split on this. Some say ESPN is a valuable asset with lots of opportunity. Others say selling could help rationalize costs and allow Disney to pursue other business endeavors. Bob Iger will likely have to decide which side he's on in 2023. Speaking of high costs, question number 4, park pricing. Will Iger do away with those Chapek-era price increases that upset fans earlier in the fall? In October, many customers were stunned to see sky-high prices for food, water, private photo sessions, and more at the parks, with the company announcing price hikes to admission tickets and its annual pass program in November. According to the Wall Street Journal, Iger was, quote, alarmed by the price increases. So will he reverse them? And then finally, who will be the next CEO once Bob Iger steps down in 2 years? According to Disney, Iger will, quote, work closely with the board in developing a successor to lead the company at the completion of his term. Possible successors include internal candidates like Dana Walden, head of general entertainment content, Alan Bergman, the chairman of Walt Disney Studios, and Josh D'Amaro, who leads the parks division. Other choices could include former employees like Kevin Mayer and Tom Staggs. Whoever it is will be handpicked by Iger himself. And considering how not so great it went last time, it's likely those conversations have already begun.
Tech faced a tumultuous 2022 amid several macro headwinds, but does this suggest a corporate governance problem for the sector? Yahoo Finance's Ali Garfinkel joins us with the details. Ali, good to see you.
Great to see you, Brad. Happy 2023. So, does tech have a corporate governance problem? That's what I sort of came into this story asking. And the answer is more or less yes, but we're about to find out just how big of a corporate governance problem tech really has. Now, why? As the macro's gotten worse, as tech's taken a hit, bad times, experts say, are the times when governance matters more than ever. Now, why are we even talking about tech corporate governance? Part of it is the way that tech companies' voting structures are set up. Now, most tech companies have something that's fairly controversial. It's called a dual class structure. Now, a dual class structure means there are 2 classes of shares. One is available to the public, and the other is for founders, insiders, and they proffer more power than regular shares. You see on the screen, this is a pretty common thing, right? And it's some of the biggest names in the space. You have Alphabet, Meta, DoorDash, Airbnb, Slack, right? Most experts say that these dual class structures insulate founders and CEOs from the desires of outside investors. But we're starting to see some cracks in the armor here for tech and for these structures, right? For instance, the common wisdom I was taught when I was first starting as an M&A reporter covering activists as well was that activist investors don't go to tech. There's nothing they can do there. But we started to see a shift, right? We have an activist at Salesforce. We have an activist at Alphabet, the Google parent. So bottom line, because of the way tech companies are set up, they are also highly sensitive to moments of lack of faith in the company's steward, whoever that may be. I mean, the thing that Eric Talley, who's a Columbia law professor, said to me was really resonant. He said, this is a zone that's a stress test for this model. So we'll have to see what happens.
Ali, I guess Elon Musk having his brother Kimball on the board of directors is perfect for corporate governance, right?
Perfect. It's exactly what experts love, as you can imagine.
What are some of their problems? What are you hearing on the Tesla front?
So, I've heard a lot. We talk, because as you can imagine, Brian, we were talking about Musk quite a bit. And one of the things, like, yes, the stuff with his brother may be not ideal, but it's actually not the big question surrounding Musk, experts say. What a lot of them say, actually, is the final question for him is how many companies can one person run at once? How many companies can be so deeply associated with a single personality? And of course, the joke is we're about to find out. One of the scenarios that was posited to me, Brian, that I thought was really interesting was actually that there could be a bidding war of sorts over Musk's attention. These companies that he's the CEO of, SpaceX, Tesla, Twitter, a lot of these companies, what they might do is they might give him a gargantuan pay package where he has to meet certain standards so that he has the possibility of spending more time there. We saw an example of this with Tesla. It was pretty controversial. Tesla paid him massively to hit certain benchmarks back in 2018 when he took the helm. So we could end up with a very strange situation with Musk in more ways than one, Brian. And it's going to be something to watch as this year plays out, I think.
All right, they better bid in Dogecoin. Yahoo Finance's own Ali Garfinkel, thanks so much for joining us with that breakdown this morning. Appreciate it. Coming up, we're going to break down some top tickers on the first trading day of 2023. That's next. We're taking a look at some stocks on the first trading day of 2023. Let's start things off with Tesla. We do know that they had just reported their vehicle deliveries and production numbers for the last calendar year. And of course, looking at the last quarter as well, they had about 405,000 total deliveries. 388,000 of those were just the Model 3 and the Model Y. However, this, of course, light up some of the expectations and even the figures that much of the street was looking for as well.
Holy cow, the bottom has dropped out of Tesla since the open. It was down about 5% in the pre-market, now down over 10%. As I would say, all these negative analyst notes have come here. A lot of price target trims, earnings estimate trims. We mentioned JP Morgan earlier in the show. I have that note now in a story on the Yahoo Finance homepage. But I guess on a positive note, as it pertains to Elon Musk, SpaceX raised $750 million at a $137 billion valuation. I'm looking at SpaceX, maybe sort of kind of a little bit of a rival. That's Virgin Galactic. That stock is down slightly here, maybe on this notion that they were able to raise a lot of this money, and maybe that is less capital that Virgin Galactic could raise at some point this year, because I think the conventional thinking is that they will need money.
Yeah, and there's Virgin Galactic, which actually opened higher and then has slid a little bit along with the rest of the market here since the open. That stock is down 74% over the past year. But getting back to technology more broadly for just a second here and looking at the Nasdaq, what's interesting here is that you are not seeing a wholesale sell-off in tech today. So you can't blame the drop in Tesla, for example, on, tech is doing terribly today. It's kind of 50-50 if you eyeball the Nasdaq, even though the Nasdaq 100 overall is down today. The exception is Apple, which is also down about 3.5%. Usually early in the year, you see people rotate into some of the big losers from the year before. That doesn't seem to be happening today, at least not universally, right? Because Apple was also, of course, down last year, and there was a lot of concern late in the year about orders for Apple products. Tesla the same, obviously. So it's kind of interesting here to see this happening. The other theme that we talked about earlier that I've been watching is China. Take a look at the Golden Dragon components, seeing a big rally there. So it's not like everybody's like, let's get out of tech today. Yeah. That's not what we're seeing.
Yeah, you could see a lack of conviction buying until this show me story that investors are waiting for in terms of some type of pause or pivot in Fed policy, until that really emanates and comes forward in clear conscience. But as of right now, there's still much of that carryover from 2022 that lingers in the mind of investors, and that permeating into the early trading activity here in 2023. Very early, though.
Yeah, one of the other really interesting moves today, rates are moving down. The 10-year yield moving sharply lower.
And Apple's still down.
As we talk about the Fed.
It's a red flag.
Exactly. That's a really good point. All right, coming up, new year, new you. Akiko Fujita and Rochelle Gufo will speak to several personal finance experts to help you with your financial New Year's resolutions. You don't want to miss that.
This is a Yahoo Finance special on financing your future with a look at a new year, new you. These are uncertain times, tensions at home and across the globe, 401ks and investment portfolios under pressure. How do you save in this volatile market? Real estate cooling, interest rates rising. How do you protect your money from inflation? The opportunities, the possibilities. Is cash king again? Reach your financial goals in the new year with money resolutions you can keep. Join us now for this Yahoo Finance special, New Year, New You.
Welcome to Yahoo Finance's New Year, New You. I'm Akiko Fujita along with Rochelle Akufo. Happy New Year to all of you. Over the next hour, we're going to be breaking down the big issues that could affect your investments in the coming year and what you can do to safeguard your cash. Has inflation peaked? Are we already in a recession? Our team of experts will look to answer those questions and guide you through an uncertain 12 months. The show is brought to you by Synchrony Bank Savings.
So as we mentioned, there are lots ahead. We're going to speak with a host of key voices to really guide your personal finance journey. Catherine George from Wellstream Advisors will tell us what we can do with any cash reserves if the going gets tough. And Akiko, we've seen increasingly people dipping into their savings because of inflation and perhaps having to pay a bit more with their loans as interest rates continue to climb. About more than 60% of Americans are living paycheck to paycheck. So really every little bit counts. And Jamie Dimon predicts that the excess savings, about $1.5 trillion altogether that they have in the US, they'll actually have run through it by this year. So how do you prioritize it? Do you pay off your debt? Do you build up your savings reserves? Do you plan for those sort of financial emergencies? It's a lot that people have to try and manage with a lot less money than they're used to.
Yeah, and we're going to be trying to answer some of those questions over the next hour. As you pointed out, there is the inflation question, but also a lot of retail investors sort of counting their losses after the year we saw last year. The S&P 500 down roughly 20%. The question now is going to be, well, where do you put that money if the market isn't necessarily working for you? And as you point out, it's not just about investments, but savings as well. And there is one more thing, Rochelle, I think a lot of people are going to have questions about, and that is crypto. We're going to be joined by Tyrone Ross, principal and founder at 401 Financial, to talk all things crypto. He says the Bitcoin blockchain is recession proof, but the token, not so much. That's going to be an interesting conversation.
I mean, it really will. I mean, sentiment, when you look at the fear and greed index, which actually tracks crypto sentiment, it's at about 26. And that's 26 out of 100. So there's a lot of fear around investing in this space. So especially if you're a retail investor, you've already been burned this year. You're seeing Bitcoin down more than 64% over the past year. So trying to sort of sort out the opportunities here, not easy. So it'll be good to get some expert insight as we separate the tokens from the blockchain opportunities as well, Akiko.
And of course, there are a number of other things that investors can do beyond just putting their money to work. There are ways to save. We're going to be talking about rates being higher, those credit card bills. If you haven't necessarily paid them off, this is the time to do it. And it's certainly very timely. Obviously, the start of a new year, new incentives in place, new goals in place. The question is going to be whether we can keep it on track. I'm not going to talk about my goals just yet, Rochelle, but it is a good time to really sort of reset the focus here going into 2023.
Absolutely. And before all that, of course, we're taking a look at the financial New Year's resolutions that a lot of people have been making, but as you can keep them as well, because 2/3 of Americans consider resolutions pertaining to their finances in the new year, and that's according to a survey from Ascent. We have Yahoo Finance contributor Vera Gibbons here with a breakdown. So Vera, a lot of people making these resolutions, what are they focusing on?
It's funny because according to Ascent, this is a record number of people making financial resolutions this year. And actually, it makes sense that we would be making them given the backdrop that you discussed. We've got potentially a recession coming. People are worried about layoffs. We've got interest rates rising, inflation continuing to rear its ugly head. So at the top of the list, you talked about this at the top of the show, is paying off that credit card debt. Now, at the beginning of the year, credit card rates were averaging about 16%. Now we're approaching 20%. So that credit card debt is becoming increasingly more expensive and will continue to become more expensive in 2023 as the Fed continues raising rates. Also a top priority any year, but particularly this year, is setting up an emergency fund. A lot of people don't have them. We are potentially headed for a recession. We don't know how bad this recession will be, but even if the unemployment rate rises to 5%, we're looking at 2 million additional people out of work. So it's good to have that emergency fund set up, not only in case you lose your job, but also for any other kind of unexpected expense that comes your way, whether you need it for a car repair, a leaky roof, etc. Revising your budget should also be at the top of the list in this inflationary environment. A lot of people haven't taken a more serious look at what's coming in the door, what's going out the door. Time to take a more serious look at that and make sure you're not spending more money than is coming in. Boosting your retirement accounts also is a huge one. You mentioned that it's been a tough year in 2022. Yes, it has. So a lot of people are discouraged based on the way the market acted in 2022. But don't give up. Keep on contributing to those retirement accounts. Keep on making those contributions as much as you possibly can, at least enough to capture the company match, because that is just free money. And last, I would say, really work on boosting your credit score. As the economy slows down in 2023, we are going to see lending tighten up a bit. So it's really important that if you want to continue to use your credit cards, that you have tip-top shape as far as your credit score goes, because we could potentially see credit card companies, the banks actually making some changes in 2023 as they tighten their standards, as the unemployment rate rises, because they don't want to get stuck with people who cannot pay. They're worried about defaults.
Vera, the third and fourth point you made, certainly going to be key here. When you think about the economic headwinds, reassessing, revising your budgets, what do you suggest in terms of how people keep track of it and stick to those goals?
Well, it's funny because a lot of people haven't taken a look at their budget. They've just been continuing to spend freely, which is why we're seeing the savings rate drop down to that 17-year low. They're spending as if they still have a lot of money coming in. They haven't taken a look at where they're at. They haven't factored in inflation. But so that is a key one for 2023. Now, in terms of keeping your resolutions in 2023, you've got to keep them what they call SMART. And that is an acronym for specific, measurable, attainable, relevant, and timely. In other words, you've got to make them realistic. You've got to chip away at the credit card debt. You've got to take a more serious look at what's coming in the door, what's going out the door. And you've really got to make it a priority in 2023, because I think it's going to be a bit of a bumpy year. We're coming off a rough year, 2023. We don't know what's ahead. Again, as I mentioned, inflation is still very hot. We're headed for more interest rate hikes. So it's going to be sort of touch and go in 2023.
SMART is a good acronym we'll all remember there. Vera Gibbons, as always, Yahoo Finance contributor. Appreciate the time today.
Thanks
so you made
much.
some monetary resolutions this year. That's a good step. The next step is keeping them. And Echo Huang, founder and president of Echo Wealth Management, joins us now to unlock all the ways to manage your money and invest. Let's pick up on that point, Echo, about what Vera said about managing inflation. That's got to be top of mind for a lot of Americans who are looking at their budgets right now. What are you advising your clients?
I think on the savings, definitely we need to focus on setting a realistic budget that requires us to do some work and plan ahead. Now is a perfect time actually to download the transactions from your credit card companies on bank and take a look at your actual expenses in the past year. You may need to make some adjustments and start a new budget and revise those numbers to really show the inflated prices. And my tips for that is create a budget that's really clear what the fixed expenses are and discretionary expenses are, so that you can focus on cutting out fat on the discretionary expenses that are, for example, like leisure, entertainment, and maybe cut out some subscriptions that you don't use frequently. And I think in terms of saving is not enough, right? So we also need to make sure that we need to invest the hard-earned money and grow your money during this very turbulent times. And so I think make sure, just as the previous speaker said, make sure you manage your debt wisely, paying down as soon as possible, especially high interest rate debt, and have rainy day fund to prepare for potential recession in the next year. So I think on money and saving, that's my advice is create a new budget and stick with it and review it very often. More importantly for me to share today is definitely in terms of how you should invest your money during inflationary period. So I think for inflation, I do expect the elevated inflation to go down in the next 2 years. So that is the good news. But right now, at 7% inflation is still relatively high. So therefore, it's even more important to focus on planning ahead with an asset allocation plan. You need to plan for success. Right now, it's extremely important to really manage your emotion, because the recent performance has been very bad. As you see that, S&P 500 lost 18% and emerging market lost almost 20%. So even bond market last year lost 13%. So really caused people to think, should I be putting my money in the markets right now? And my answer is definitely, here's how you can get started. I think first, you should have asset allocation plan. Ask yourself 3 questions. One is, what are my investing objectives? And second is, when do I actually need the money? And the third one is, how much risk am I willing to take to earn that kind of return? I think if you work with a financial advisor, you can construct a portfolio that is fit for you.
So let's break some of this down, because obviously for some people who have just started perhaps reviewing their statements from last year so that they can set the stage for the budget, how should they prioritize? What should they start with first so that they know that they're in a good and stable position to start investing?
Yeah, I always tell people that as you look at your cash flow, it's really important to plan for the next 1 to 3 years of cash flow. The rainy day fund in general, I would say to have 3 to 6 months minimum enough cash in a savings account, maybe some online savings account that pays higher interest rate to pay for your living expenses in case you need to change your job. After that, and of course, the very high interest rate credit cards, definitely that needs to have a plan to pay it down. My general advice is also tell people to, at this time, postpone the major purchases like cars or homes. And I don't recommend people leasing cars in general, because the mentality would entice you to change your cars very frequently. That would also reduce your savings. So once you set aside enough money for rainy day fund, I tackle the really high interest rate with a plan and pay it off. Then don't miss the matching contribution at work. Make sure you put in something at least to catch that. And then every time you get a raise, and you should increase your retirement contribution. And also, I think you should increase your earned income by asking for a raise if you haven't received one because of high inflation.
So you sort of broken down how to trim some of your costs there. There's a question of how you grow your money. Certainly a lot of investors got burned in the market last year and are wondering, well, where do I put that aside? I mean, is something like a high yield savings account a better place to park your money right now, given the uncertainty in the market?
Actually, for the long-term money, that requires long-term strategies. So I do not actually recommend people to park most of their money in high yield savings account. That is a good strategy for the short-term expenses. As I said, anything you need to pay 1 to 3 years would be good in a high-yield savings account. But for the long-term goal that you don't have to touch the money for like 8 or decade, from now actually lower valuations and higher yields today offer the best potential long-term return since 2010. So if you look at this, nobody knows when the bottom of the market is, right? If we are in a recession, but I must stress that it's important to continue putting money in the market and of course have a solid diversification plan. So it's not just putting in all in stock market if you're not willing to take on the risk. And so your portfolio can be diversified, including some bonds, US large companies, small company, global stock, and also some real estate. One data I want to make sure I emphasize is if you look at the data for Wilshire 5000 since 1971, after the 9 months worst return, you look at all these periods, and then look at what happened a year after that, average return is actually 12% after the 9 months worst period in the stock market. And 3-year return after that, total is 41%. So if people are thinking about, I probably have at least 80% of a portfolio I don't really need to touch for a decade.
Mm-hmm. Right.
Think of this is the perfect time to put money in to have
and you
that
raise a good
additional boost or return. Yeah.
Yes, you raise a good point. It does definitely depend on the time horizon. Unfortunately, we will have to leave it there. I know you have a lot to say, and I know a lot of viewers will probably be having some questions for you as well. A big thank you, though, to Echo Wealth Management founder and president, Echo Huang. Thank you so much. All right, coming up, getting defensive. Economists lining up to call for a recession. So if it's time to go long on bonds, how do you get into the trade? We talk opportunities in fixed income and why the curve matters. That's next.
Welcome back to New Year, New You, brought to you by Synchrony Bank Savings. Well, let's take a look at bond market performance today, tomorrow, and even far into the past. We've got Yahoo Finance's Jared Blickery at the Wi-Fi Interactive to walk us through this one. Jared.
That's right. And let's start out with the bond market. As we've been talking about, this is the 13-week T-bill, so technically not a bond. This is the short end of the curve. This tracks what the Federal Reserve has been doing. And over the last year, we've had a surge of activity. It went from near zero, accelerated in the summer, and then started plateauing later in the year, but still going up. And very important to understand that. That has put considerable pressure on risk markets. Now, here's the S&P 500. 1 year ago, the market was making record highs. First time we ever made a record high on the first trading date of the year. And you can see we're still well within a bear market, trading at the lower end of the range here, down 20% over this time period. Now, was it a bad year for bonds? Yes, it was. In fact, it was a worse year for bonds going back about 100 years. You'd have to go back to World War I. After World War I, as that was wrapping up, we had a worse year. And also interesting is that we were coming out of a pandemic, the worst pandemic since the very recent one that we had. Also interesting to look at this chart because B of A has done a great job of going back all the way to the 1700s. South Sea Bubble, if you guys haven't heard of that, you should look it up. But the Civil War is in here, post-World War I. UK going off the gold standard, Marshall Plan, that's World War II. Suffice to say, these are game-changing moments for the market. Now, let me show you my next slide here. This is negative yielding debt. Why is this here? Maybe out of place? No, because I am seeing this as the final chapter on easy money. Negative yielding debt was an experiment that grew in the era of easy, cheap money. And look at that decline here from the pandemic stimulus to right now. That is round trip to zero. Not saying it can't go up again, but I think this is probably in the history books as a failed experiment. Now, looking ahead, January actually has very positive seasonality, especially in the third year of the presidential cycle, which is where we are right now. You can see this is the Dow's second best month out of the year. S&P 500 and Nasdaq, that is their best month of the year, number one place there. And stocks go up. Dow usually goes up 4% in January, S&P 500 about the same amount, and the Nasdaq almost up 17%. And a really good track record over the years since 1950. 16 up, 2 down, 11 up, 2 down, only because of the time period that we're looking at here. So we could see some activity pick up in January. And there's an old saying, as January goes, so does the year. That's in play too. So January, a very important bellwether for the entire year. I want to close on this. This is a look back on the total days when the S&P 500 index moved 2% or more. And this goes back all the way to the 1960s, basically the beginning, almost so. And you can see we are in an era of elevated volatility. 2020, 2022 really impacted the markets because of that high volatility. And there's no reason to think that it's just going to disappear out of the blue this year. But we'll have to see. Akiko and Rochelle.
Indeed, but certainly that history really helping there, give people some perspective, perhaps if they do need to hold on, if they do have a longer time horizon. Jared Blickery, great stuff. All right, cashing out. As inflation continues to outstrip the value of cash, investors are taking a closer look at liquidity, comparing it to short-term investment instruments, various forms of debt, and of course considering just how much they should have on hand. Well, joining us now with more is Catherine George, Wellstream Advisors Senior Advisor. Good to see you, Catherine. So for a lot of people wondering, obviously, when you have changing interest rates, when you have inflation, your budget isn't going to be the same as it was. How do you calculate how much cash you need on hand?
So it's really personal circumstance, but I'd say a general rule of thumb is anywhere from 3 to 12 months of expenses, depending on your job security, or do you have positive cash flow every month, or any upcoming expenses like a car purchase or a down payment or a home renovation. So really narrowing down what your expenses are and then building up a cash reserve that would satisfy those amount of expenses for 3 to 12 months.
What should that ratio look like? We were asking our guest earlier about, how much you should put money towards investments, how much cash you should be setting aside, how much should be actually being held in a high yield savings so that you get some return on your money. How do you look at that breakdown?
So all of your cash should be earning something, right? So now that we're in a higher interest rate environment, online savings account are a really great alternative to your typical checking, brick and mortar savings account. Online savings account are offering 3.5% in some cases to just have your money sit there. That's free money. So I'd say all of your cash, except maybe your month to month needs, should be earning some of that cash. Now, anything above this target that you have set for yourself, and really being disciplined about this target. And once your cash starts to get above, let's say, 6 months of your expenses, then you should really be putting that into the market. It's January, so we always think about going back to the gym and getting fit. And it's not kind of a one-time fix-all solution. It really requires consistency. And it's the same thing with your investments, being consistent with the monthly or weekly investments in the portfolio. And I'd say that, once your cash reserve is established, this is the best time to get in. We think about the saying buy low, sell high. And sometimes it can feel really hard to do that because of where we are in the market, but that's what we're doing right now.
And Catherine, you mentioned discipline and consistency, and a lot of us didn't have any sort of formal training when it came to financial literacy. It was money habits we pick up, and that really does determine how much risk we want to take on, how comfortable we feel taking risk, if we have any sort of cushion. So when people say come into a chunk of money, say a bonus or some sort of raise or something, but you still have the same old mindset, what should you do in terms of applying it to debt? Because obviously not all debt is created equal. You have student loan debt versus credit card debt.
Right. Well, so there's even differences within student loan debt, right? So private versus federal. Right now, the federal student loans are on pause, those interest payments. So you could actually earn more just having your cash sit in, 3.5% online savings account. And that's what I would recommend for that until we're required to start to, pay those down again. But credit cards, you might be paying somewhere in the 20% range, and that is more important to pay down than building up cash. And sometimes even private student loans can be higher yielding debt. So that's important to pay off too. But really, it's comparing what can I earn on this money outside, whether that's investments or cash, versus what am I paying in interest? And that's really where the math comes into play. But when we think about discipline and consistency, whether it's paying off debt or whether it's investing in the stock market, I think it's really important to come up with a plan so that if something comes up, you have something to rely on. So to me, that means, okay, let me take $25 every paycheck and put it into the savings account, and then being disciplined with that. Starting off with a number that feels doable. And once you can master that, maybe you can edge up a bit.
Some good takeaways there. Catherine George, WealthStream Advisor, Senior Advisor. Appreciate your time today. Well, coming up on the other side, staying guarded. Recessions tend to begin with small businesses, and many of those see a downturn on the horizon. But how are they and you preparing for it? We're going to look into that and ask if inflation has truly peaked after this short break.
Well, inflation continues to weigh on consumers into 2023. So can you guard against it with an emergency fund? Let's get to Yahoo Finance's personal finance editor, Jana Heron. So Jana, we hear a lot about the need to build an emergency fund when things go wrong. But what exactly should we be accounting for in it? And how much do you need to save up?
Sure, those are great questions. And I think one of the first things is to really define what an emergency is, because sometimes we think something might be an emergency and it's not. So I like to think of these, remember in the pandemic, we had stimulus checks. So an emergency fund is kind of your own personal stimulus check when things go south. You want to tap into this fund when you have an unexpected expense or expenses that, if left unpaid, threaten your personal safety or health, the health or safety of your loved ones who depend on you, so your children, your spouse, or it threatens your ability to make money. So those things are emergencies. So that can be a medical emergency, such as a broken arm or leg, or you need to get your heat fixed in the middle of winter. That definitely is an emergency, or a car repair so you can get to work. Of course, there are other expenses out there that are very important. You want to pay your credit card bills, you want to pay your student loan bills, but oftentimes you can negotiate with your lender for a hardship plan or a payment plan in those instances. So really, personal safety, health, those of your family, and your ability to make money, that's what an emergency fund is.
So, Jana, we've established what the fund is, that you need to set it aside. The question is, how do you go about building it? How much of your monthly income, let's say, should you be setting aside for it?
So the big goal here is you want 3 to 6 months of your essential bills saved up. And 3 months for 2-income households, 6 months if you're a 1-income household. Now, this is a huge amount. And if we've heard the statistics, right, that a third of American households can't cover $400 without borrowing or selling something or just not covering it all. So what I would say is start small. Allocate either your tax refund, your bonus, a little bit of your income, any side gig money, and try to save up for that biggest bill payment that you have that's essential. So for most people, that would be your housing, your rent, or mortgage payment. And so at least you start with that and you have some peace of mind. If something goes wrong, well, at least I have my housing payment covered for next month. And then you can build up to the 1 month, and then 2 months, and then 3 months. And you just don't want to get discouraged or overwhelmed that you need this huge amount of money. Start small. At least you'll have something if things don't go right.
Yeah, start small and build on it. Something to give a lot of Americans peace of mind. Yahoo Finance's personal finance editor, Jana Heron, thanks so much for that. Well, coming up, new year, same Bitcoin. After a chaotic 2022, it's probably more useful than ever to be crypto literate. But are you clear on why the Bitcoin blockchain and the token are very different beasts? We're going to discuss next.
since 2008 have been saying this is not a substitute for fiat money, never can be, and never should be. But at least there are uses to it, and there are potential uses that can come out of the blockchain distributed ledger technology that have nothing to do with cash.
Welcome back to New Year, New You, brought to you by Synchrony Bank Savings. Well, that we just heard from was Yanis Varoufakis, an economist who's been outspoken on the crypto sphere. He was discussing the difference between tokens and the blockchains themselves. And as we start 2023, it's very much new year, same Bitcoin. It's still on the hunt for catalysts to make a meaningful push higher amid noisy calls around its valuation. Cathie Wood remains the standout, calling for $1 million by 2023. Venture capitalist Tim Draper sees $250,000 by the end of the year. And Mark Mobius settling in on $10,000 value by this year. Our next guest says crypto is not recession-proof, but knowledge of crypto is. We're joined by Tyrone Ross, 401 financial principal and founder. Tyrone, so I think a lot of people would agree with you that knowledge is very key after the kind of year we had in 2022. What are you thinking as you go into this year in terms of how investors should be putting money towards the space?
I think it's simple. I think we've learned last year that those that considered themselves investors weren't that. They were traders, they were speculators. So any great investor in any asset class does a lot of research, does a lot of work, asks a lot of questions. And I think that's what we need to step back here and do. And I think the way to do that is exactly through forums like this. Get folks to understand it's about education first. Understanding what the asset is, what it does, your time horizon, what the goal is, and not a second before that should you put $1 into any platform or any crypto asset.
So Tyrone, though, when you hear about some of the valuations, when you hear a Cathie Wood talking about $1 million, other investors talking about $10,000 for Bitcoin, as a retail investor, then what are you supposed to make of this? How do you determine how you should really chart your course from here?
Yeah, that's a great question. I don't make price predictions. God bless those folks to do it. I love Cathie Wood, but as much as I am a crypto hippie, I don't make price predictions. What I think the everyday investor should look at is this. There's a difference between the Bitcoin blockchain as in the video that you were just showing and the actual token. The utility is in the Bitcoin blockchain running every day, every 10 minutes, a block is mined. That provides financial infrastructure for folks that has never had it. That is the most important piece here. Similar to like the internet. I can do things on the internet, can't really value it, but the companies and things are built on top of that. If you are a retail investor and say, you know what, the fact that this is reaching so many people and it is a technology that I want to understand and I want to own a small piece of that to kind of be a part of the growth, only then you should look at putting money in, not because someone said that the price is going to 250,000. That has always been a sucker's game.
Yeah, get rich quick, certainly not a big strategy. And you have been very clear that because you believe in the utility of the blockchain, you think that the long-term investment is still a lot of upside there. How much for those who are trying to dip their toes into the space? Are we talking 1%? Are we talking 2%? I mean, what's your advice?
Great question. So I get this a lot. It's hard to say 1%, 2%. I'm probably 100+% just because of who I am and I know it and I live it every day. So it's hard to say that without knowing someone's age, knowing what their savings are, knowing what their time horizon and goals are. It's hard for anyone to come up here and say that. And anyone that you do interview to say that, you should cut them off immediately. But here's what I think folks should do. If you have any interest in any crypto asset whatsoever, here's what you should do. Go on Google, look at the local 3-star, 5-star restaurant and what it costs for 2 people to eat there, drinks, breadsticks and everything included, like you go in the Olive Garden, and put that much into a crypto of your choice and let it sit there like a pet rock for a year and just watch it and see what happens. And then learn from that experience of opening the account, read the terms of service, by the way, the hitting buy on that, and knowing that if you wake up tomorrow and that money is gone, you will still be able to live your life. You tried to play, it didn't work out for you, and you can move on.
So as people are determining whether or not to invest in crypto, I know that you don't advocate it for retirement plans, but as people are trying to figure out perhaps blockchain companies that they could invest in, what criteria do you use and which companies are you eyeing at the moment?
So as far as actual public companies, I think obviously the one that everyone throws around is Coinbase. Coinbase was eviscerated last year in terms of the stock price, but I do think Coinbase has a sustainable business there that I think folks would be able to look at and say, all right, here's a company that has been around. They are public. They have to, provide particular registrations and filings every year. So you can feel comfortable with that. There are some other companies that are kind of teetering on the outside of dealing with the technology. You have Cash App, which is part of Block. You have Facebook as well. But again, you've seen the stock prices of all these companies come in. So I think whether you want to invest in companies that are dealing in crypto or the actual crypto themselves, a lot of caution, high risk tolerance, lots of liquidity, and being able to say, all right, this is what I'm buying. I'm going to buy Coinbase at $40. No matter what happens when it hits $80, I'm out. You have to have that agreement with yourself with any asset class, because if not, then you'll continue to be like the wind. You'll go whichever direction is going, but you should be standard and set in your financial plan what your goals are every day, every year, and only make movements based on that knowledge.
Definitely an exit strategy, certainly important. A big thank you to Tyrone Ross there, 401 financial principal and founder. Thank you so much for joining us this morning. All right, coming up, turning big inflation into big opportunities. After the pain of 2022, could there be a chance to get refinanced in the year to come? We'll ask How to Money author Jean Chatzky. Don't miss it. Turning now to our chart of the day. Americans seeing their personal finances through an increasingly gloomy lens. 36% of Americans seeing their finances stay the same. This according to a Bankrate survey taken in November. Now, there is still optimism, with more Americans seeing things improve rather than turning worse. Well, let's also talk about digging out of debt, because for American families trying to right their financial ship, the PBS television show Opportunity Knocks is trying to provide actionable advice on how to rearrange their financial lives. Well, joining us now is Jean Chatzky, financial expert and a coach on the PBS television program Opportunity Knocks. Good to have you on, Jean. So in dealing with different families and their different financial situations, what are some of the things that you've really learned about how American families are actually doing at the moment?
They're not paying as much attention to the little things as they need to be. I think that was one of the overriding themes. Look, 2022 was a pretty uncontrollable year. We had the highest inflation we'd seen in 40 years. We had interest rates going up. We had the stock market and the bond market both doing poorly at the exact same time, which typically does not happen. There were so many uncontrollable factors. And our goal as coaches on Opportunity Knocks, as well as my goal as a coach in the Finance Fix program that I run at hermoney.com, is to get people back in touch with those things that they can control. That means you need to know what's coming in, what's going out, and where it's going. And we put people through a process of getting in touch with their cash flows, really knowing their data, because only when you know can you make changes. Now, the sunny side of all of this was, of course, the jobs market, and the job market is still good to this day. And so if you're looking to right your financial ship, if you're looking to save a little more, maybe put a little more into your 401k in 2023, you want to be looking at your earnings power.
Yeah, Jean, let's hone in a bit more on that part that you can control. Obviously, your earning power, one, but we've heard a lot from guests today about credit card bills, making sure that's intact, being able to pay that down. What about the rates themselves? Because those rates have gone up. To what extent do you think Americans should be thinking about renegotiating those rates? Is there something they can do?
There absolutely is. And it comes back to one of those other things that you can control, and that's your credit, right? Credit is just a formula. You pay your bills on time, every single time. Your credit score is likely to be in pretty good shape. And that gives you room to negotiate with your lenders, whether we're talking about your credit card companies or whether we're talking about your car loan. A lot of people go in and they buy a car and they don't even think about the interest rate, which right now can be really troublesome. Well, there's a story out just last week that credit unions are charging 3% less than banks on average on car loans. That's real money in your pocket, and refinancing a car loan takes minutes, not months like you're used to with your home. And as far as those credit cards are concerned, particularly for people who still have good credit, there are balance transfer offers out there. You want to take advantage of them and then use that balance transfer period, 12 months, 15 months at a 0% interest rate, to just pay off as much debt as you possibly can.
And as you mentioned, a lot of this comes from really keeping track of where your money's going when you're seeing interest rates change and perhaps not really doing anything about it. What sort of perhaps apps or services do you think people would find most useful if they're trying to really get a hand on their finances?
Look, this is what we do at Her Money with our Finance Fix coaching program. We call it getting dirty with your data, and we take you by the hand and we help people do it. And we have new courses starting every month. But you can do this with pencil and paper. You can do this with the flows of money that you watch through your online bank account. It sometimes helps to have a coach to keep you accountable. But if you're willing to put in the work and follow the flows of your own money, it is eminently possible with technology to help you.
Jean Chatzky, financial expert and a coach on the PBS television program Opportunity Knocks. Good to get your advice today. Appreciate the time. Well, coming up, don't get stressed. From taxes to inflation and two major spending events in February, we've got your personal finance calendar covered after the break. You don't want to miss it. Now let's get to your new year, new you personal finance calendar for the beginning of 2023. There's a lot of events you'll need to be on the lookout for. So let's kick things off here with getting a sense of the overall health of the economy with this Friday's jobs report. Then on January 12th, we're going to get the first major inflation reading of the year. Then looking ahead, there is a Fed rate decision on February 1st. After that, two big spending events on the horizon in February. You've got the Super Bowl on the 12th, followed closely by Valentine's Day on the 14th. You don't get caught out, depending on how elaborate your Valentine's Day plans are. Finally, one of the two certainties, I should say, in life, and that is, of course, taxes. The key date you need to know for that is April 18th. That is when your individual return from 2022 comes due. And Rochelle, I would argue sort of like the first few events that we pointed to, obviously the health of the labor market, as well as inflation reading, something that you can imagine investors really paying a very close attention to, because that does affect so much of what we've been talking about, which is interest rates. And as we've learned, whether it's credit card bills, your mortgage payments, your car lease, so much of that is going to be tied to what we see the Fed do.
Absolutely. When you think about the domino effect, so these events don't just happen by themselves. They do have an effect on our everyday lives. If you're having to pay a bit more on your car note, that's a bit less that you're going to have to budget for something else. It might be time to perhaps take a look at the multiple subscriptions that all of us have now and probably aren't keeping track on. As Netflix adds $1 or $2 here, or Prime adds, another $20 here. It all definitely adds up. And when you think of things like taxes, that terrifying time when it all really comes home to roost as to how you've really done over the past year. When you're looking at things like your 401k, you've seen, it's been a very tough year for 401ks, and hoping that we'll see something of a turnaround perhaps in the second half of the year, but really having that mindset of, what do I need to do? Perhaps I need to spend a little bit less on the Super Bowl, maybe not have Valentine's Day, maybe, risk getting in trouble, not spending that much on Valentine's Day, and just do what you have to do at this point.
Yeah, I don't know. I've never gotten the blow your budget for Valentine's Day, but maybe that is just me, that I wouldn't say I'm not a romantic, but there's other days you could spend your money on. You get the sense, though, I should say, in so many of our guests who've talked about setting that emergency fund, that's certainly going to be key. Paying down the credit card, something that I know a lot of Americans think about at the beginning of the year. That's always a goal that's been set. And yet, because of the uncertainties, especially around the economic conditions, you get a feel that might be really key priorities here, at least in the personal finance department, for so many Americans who are saying, well, where is this economy going, 3 months from now? Those calls for a recession by, potentially sort of mid-year, end of year, that's got to be weighing on a lot of people.
And you figure that's when we really sort of lay out the fixed versus the discretionary spending that we need to do. A lot of things that really aren't a priority. If you have to prepare for the potential for a recession, you just have to do what you have to do. All right, well, that'll do it for this edition, but we're going to do a final check of the markets quickly before we go, as we take a look as we're heading into the afternoon hour. They're all three major indices in negative territory there. The Dow off more than 200 points, the S&P off more than 35 points, the tech-heavy Nasdaq there down about 1.33%. Well, that will do it for Akiko and myself. We'll be back tomorrow. Thank you for watching. We'll see you then.